All right. Well, fantastic. So I have it now as 2 o'clock GMT UK time. So welcome all of you. Hope you had a fantastic Saturday. Or you're having a fantastic Saturday, depending on what time zone you're on. And how many of you, just out of curiosity, woke up early in the morning? How many of you guys are like, oh, 8 a.m. in Texas? How you doing? Okay, we got folks in Texas. So how many of you are actually 6 a.m. in Vancouver? Wow, Riza, that's fantastic. Well done to you. Well, well done to all of you, by the way. So certainly not discounting those of you who maybe on a different time zone. Welcome to all of you guys. So let's get started. 3 a.m. in Honolulu. Michael, wow. Honolulu, that's amazing. Okay. All right, so let's get started. Okay. Welcome to the Beginner's Guide to Trading. And I thought, my purpose for this webinar was, to do a lot of the stuff that books and websites out there don't do. And you'll see why, because there's a lot of information that books give you, just overwhelm you with what I call it analysis paralysis. There are books out there, for example, that will teach you all kinds of different strategies and God knows this indicator, that indicator. And I thought, you know what, that's ridiculous. You don't need all that. You don't need every kind of analysis. And I actually think overanalyzing the market is a really bad thing. That's why there's a phrase that we call it analysis paralysis. And that's why when I first started, just like many of you probably first started, or maybe you are starting, one of my mentors, as a joke, called me, and I don't want to say it, but it's kind of, but he called me an analyst. Not an analyst, but an analyst. You probably know why. But I had to really change my mind about, I realized that, the worst kind of trader are the ones that overanalyze the market. There's nothing wrong with analysis of the markets, but there is such a thing as overanalysis. So my really guiding principle, guys, before I even start this webinar, I've got a little blank sheet here. Can you see this? Hopefully you can see this, guys. Yeah. So my guiding principle before we even start is this: keep it simple. Or if you're in Britain, keep it bloody simple. All right, let's get rid of that. I don't want to say that, but keep it simple. All right, guys? Please, please, please keep it simple. If you just remember those 3 words, believe me, everything in life and everything in your trading will be awesome. All right, so a little bit about, I know that most of you probably have seen me before or have heard of me, but I know some of you probably haven't. So for those of you who haven't or who don't know who I am, I'll just give you a quick background. I actually started many years ago, not in trading, but actually my parents wanted me to go into medicine. Guess what? I didn't get into medicine. I got the grades, but they didn't accept me. So I went into dentistry. Guess what? I hated dentistry. It was the worst decision. That's probably a lesson in life that, don't just go into something blindly because your parents want you to do it. I did 2 years of dentistry and I hated it. Then I went into law. I actually liked law, believe it or not. But it's just the fact that I didn't like the lifestyle of always having to work for somebody else. As you'll see in this webinar, the reason why I picked trading and the reason why most of you are here in this webinar, because I've never been the kind of person who wanted to work for somebody else. I've always liked the idea of being self-independent, recession-proof my life. What you see here is a picture of me in my office. Actually, this is where I do most of my research and my trading. Here's a picture of me actually doing. I do seminars. I've done seminars all over the world. Hong Kong, London, America. So I do actually enjoy doing a lot of that. I'm guessing most of you probably remember me from this infamous video now on BBC about a year ago, where I said some shocking things. Such as I'm dreaming of a recession. John says, you're too good of an attitude to be a dentist. Maybe you're right, John. But anyway, so I did say some shocking things. Governments don't rule the world. Goldman Sachs rules the world. By the way, people always say to me, do you have regrets about what you said? Absolutely not. I stick to everything I said. I will say this, though. I remember at the time, people emailed me and called me up saying, hey, Alessio, WTF, what are you talking about? Why did you say I'm dreaming of a recession? What does that mean? And I think, I'm guessing most of you probably know what I meant. I think probably mostly traders know what I meant by this than other just normal folks. But by no means, I want to make it clear right now, I did not mean that I think a recession is a wonderful thing. Of course it's not. Like many of you, my parents, I remember during the 1990s recession, suffered a lot. I mean, I remember that, in the early 90s recession. How many of you remember that, by the way? It was a terrible recession. My parents suffered through it. So definitely, I don't think it's a wonderful thing. However, as a trader, you do see a recession or a market crash as an opportunity. All right. Why is it an opportunity? Because, and many folks who don't know about trading probably don't know this, but let me just do it here for you. The simple fact why I call myself a closet bear, all right, sounds kind of kinky, I know, but anyway, so is because when markets go up, they do this. Okay, this is when markets go up. They do sort of a staircase pattern, you know, going up like that, you know, take the staircase up, and that's why the phrase is markets take the staircase up, but they ride the elevator down. All right, they go much faster on the way down. Yeah, kaboom, John says. So that's why I prefer these kind of conditions when markets go down. All right, that's all I meant by it. If you know how to make money in a market crash, my aim is to show you how you can go about doing that. You can actually make a lot more money than if you would in an upward market. All right, so let's go back and just erase all this stuff. Yeah, people always say, you know what was your favorite moment out of the whole thing? I'll say this to you right now. Many things. I mean, I got letters, emails from thousands of you giving me my support, saying thank you for being honest. Thank you very much for that. But also my favorite part was meeting one of my heroes, Sir David Frost. Some of you know from the famous TV interview between David Frost and Richard Nixon. If you have never seen those interviews between Richard Nixon and David Frost, I recommend. It's fantastic TV viewing. And David Frost just wanted to ask me, you know, what is it all about? What did you mean by that? So that was a fantastic thing. The other thing that I really enjoyed about the whole thing, and I'm going to share this with you probably for the first time, is that all those newspapers that first attacked me, so there's a lot of backlash from the media, especially some corporate newspapers say, oh, Alessio is wrong. He's out of his depth to say that Goldman Sachs rules the world. Those newspapers, within a few months, or maybe just about a month or so, all right? This is what they said. This is the Telegraph. They said, maybe Goldman Sachs really does rule the world after all. That's a maybe, by the way, all right? And then, about a few weeks later, what they say? Goldman Sachs rules the world, okay? This by James Dillingpole. And he wrote in his article, Rastani was absolutely right. Goldman Sachs really have the world squeezed tighter and tighter. All right. Now, I'm not actually showing this to blow my trumpet. Just going to show you kind of background as to how the whole thing kind of happened and evolved. All right. So why do we trade, and what is it all about trading? I'm going to show you that it isn't actually a choice done just because you feel like it. You know, it's not. I don't think that trading. I chose it, or most people choose it just because they feel like it, or because it's a cool thing. No, it's not like that. There's a lot more to it. It's about freedom. It's about being self-independent, not having a boss, you know, being financially independent. I don't know how many of you like the idea of commuting every single day to the city, especially if you live around London or New York, but I don't. I do commute to London like two or three times a week, but even then I hate it. All right. So, yeah, it's about recession-proofing your life. There's a lot to do with that. Here's what I mean by this, by the way. I just want to quickly show you this because it is important, because I know many of you who come to this webinar may be thinking, you know, should I go into trading? Or some of you probably thinking that trading, again, there's a lot of folks out there that truly think that trading is just a lifestyle choice. I do not believe it is. I think that for me, trading is a must. And I know for a lot of you is the same as well. Why? Because most people, the way they've been taught, and this is the way I was taught, by the way, as well, is that you go through life essentially doing what's on the right-hand side of this picture, okay, which is what? Most people, they've been taught by their school, by their parents, same as me, by the way. This is the way I was taught, that you go through life getting a degree in education and then getting a job. By the way, can anybody here tell me, who knows this? What does JOB really stand for? Who knows what JOB stands for? Can you tell me? Type it in your box. Thank you, Denise, Ross. You're absolutely just over broke. That's it. That's what actually, it dates from medieval periods. I believe in medieval periods that the phrase was just over breadline. So that's how it came up from just over broke. And the thing is, there's a lot of truth in this, because if the only income that you have is from a job, that is by far the riskiest thing you can do. But unfortunately, many people out there, and we all know them, probably your friends, people you know, that's all they do. They think that's the whole purpose in their life is get a job. And if you watch TV nowadays, it's all it is. I want to get a job. I want to get this. But that's not, in my opinion and in my view, a job is just a means to an end. I think the only reason you should get a job is to build a sort of savings account, build sort of an income, which then you can put into something else. For me, it was put into a trading, put into my trading. All right. For some people, it's to put into their business. So this is actually what most people do. You know, they have a job, they go and drink their beer, they buy their luxuries, buy a fancy car, and guess what? When finally the I don't want to say the nasty word, when that hits the fan, when the recession hits, when they lose their job, what happens? Everything falls apart. And by the way, that is exactly what happened to a lot of friends of mine. Many of my friends who I studied law with, they went into property law. Okay? Now, in the good times of the property business, they were doing really well. But as soon as the housing crash happened, guess what? They lost their jobs. I know, I actually spoke to a woman who was a property lawyer. When the recession hit, when the housing bubble burst, guess what she was doing? She had to, I mean, I felt really sorry for her, but she was working in a call center. This is a lawyer working in a call center. That's how bad it was. And that's the problem is. The whole thing is, guys, for me, and I think for many of you, I think as well, you know that a job is just not enough. You got to have something else, an income from your trading, maybe a business, or maybe a property as well. So this is what it's all about, all right? And instead of investing in junk like this, you know, we should be investing in ourselves, okay? Investing in ourselves and having assets, proper assets, education, shares and stuff like that. Okay. So I hope that kind of clears that up before we go into trading itself. All right. By the way, folks, I know you're going to have questions for me as we go through this webinar. Because I'm limited to 2 hours, so I really want to kind of encourage you guys, if you have a question, write it down on a piece of paper, and I promise I will answer it for you at the end of the webinar. So just keep your question on a piece of paper and post it to me on your chat box. And if you have an urgent urging, like if it can't go away, then by all means ask it if you want. And if I see your question, I'll try and answer for you. But if I don't answer it during the webinar, please don't think I'm being rude, but I will definitely answer for you at the end of the webinar, okay? Okay. Yeah, Simon, the chat is working. I can definitely see your, yeah, I can see what you guys are sending here, okay? So, right, so let's get started. Trading is a game of probability. And what do you mean it's a game of probability? I want to ask all of you a question. If you had to go to a casino, okay, I don't know how many of you have been to Vegas, for example. Let's say you want to land on red to win. You want to play a game like roulette. You got to land on red to win. Which wheel do you play on? Okay, do you play on wheel 1 or do you play on wheel 2? Remember, you got to land on red. What do you think? Exactly, it's wheel 2, right? Now, I know it sounds like a ridiculously simple question, but believe it or not, many people do not realize that when they're trading the markets, they're trading on the wrong wheel. Most people who enter going to trade in the markets, they're playing on this wheel over here, on the left one, without knowing it, by the way. So how do you go from wheel 1 to wheel 2? Well, you got to put the odds in your favor. And really, my purpose in this webinar is to show you how you go about putting the odds in your favor. But it isn't just about putting odds in your favor. It's also about minimizing risk, maximizing profits. And that's what a lot of folks, what a lot of traders have problems with. By the way, let me ask you this. What do you think these black slots are here for? Look at wheel 2. What do you think these black slots that you see here, what do they mean? Yeah, there's risks. Yeah, there's never such a thing as 100% certainty in the markets, all right? So really, even the best traders know this. It doesn't matter how much analysis you do, there's always a risk involved, which is why it's important to take care of those risks and minimize them as soon as possible. Now, I want to begin this webinar by sharing this with you, which is this. There are 2 types of information, and that is information for the masses and information for the classes. Okay. So what do we mean by this? Information for the masses, and by the I think this is missing from a lot of literature out there. Okay, just to let you know. Many people don't even talk about this, but I really want to share this information with you because it's so important to understand. Information for the masses is a lot of the garbage that we get, all right, from, for example, news channels on television, newspapers, and magazine, all right? So what about CNBC and Bloomberg? Let me ask you this question. How much time do you think professional traders spend watching CNBC and Bloomberg? Let me know. Yeah, precisely. The answer, the answer is, in case, is this, 0. Believe me, I tried doing it. When I first started, that's what I would do. I'd have CNBC in the background, and I realized, I didn't realize at the time what a mistake that was. Right? So yeah, you're absolutely right. It is total garbage. And here's why. I'm going to share this with you. This is so important. All right. Let's go back to the arrow here. Have a look at this. This is the crash of 2008. This is when the market crashed in that era. All right. Now you can see that in 2009, the market started to rally. Now, why is this important to understand? Because remember, if you look back in 2009, 2010, if you picked up the newspaper, if you watched the TV or television channel, all they would talk about is recession, depression, all that kind of stuff. Bad news, bad news, bad news. The fact is, though, despite all that bad news, despite all the recession we were in, the market rallied hard from 2009 to 2011. All right? Why? Well, let's go forward a little bit here. Take a look at this. This is more recent now. This is in the last 12 months. So back over here in August of last year, you can see the market, I mean, we were in October, September of last year, the market crashed so hard. Well, I say so hard, but I mean, there was so much volatility and so much turmoil in the markets that we were almost on the brink of a global recession. I mean, there really was fear that we were about to go into a global recession back then, all right? But you'll see this, that despite the fact that almost everybody was saying disaster, disaster about this point last year, the market rallied here, okay? And over here as well. This is June. This is June of this year. Again, with all the uncertainties, with all the mess we're in, you know, with Spain going bankrupt, with Greece, you know, with all the trouble that Greece is going through, all these other countries in Europe, with all the mess we're in, the market are going higher here. So everybody's kind of thinking, and this is the question everybody's been asking me, Alessio, what's going on here? Why is the market going up when we're in such a mess? You know, is the market crazy? Now, so let's understand this. Why is the market going higher despite all the negativity and all the bad news out there? All right. So guys, what I'm about to share with you here in this part of the webinar is by far one of the most important things, okay, you're going to learn. And let me just say this. If you understand this point, if you understand this very point in the webinar, this will put you ahead, way ahead of most of the people out there. I think this will put you way ahead about more than 90% of people out there, okay? The news is completely irrelevant. Okay, write it down somewhere on a piece of paper. It does not matter what the news is, all right? Now, I know some of you are probably scratching your heads and probably thinking, why? Surely the news is important. How many of you, for example, maybe saw the American president come out and say, hey, we've just come out with some good news that we're going to increase jobs by about 100,000. And the market continues to plunge lower. So the president comes out and says, we've got 100,000, we're going to create 100,000 more jobs, yet the market goes down. So this will actually begin to make more sense to you, what I'm about to say to you here. What is really going on? Okay, here's the most important thing, probably one of the most important things I'm going to mention to you in this webinar. There are about 20 funds in the world that do 80% of the world's trading, okay? They have, okay, these funds about 50 to 100 billion dollars under management. We're talking about the big money here, guys, okay? We're talking about the folks that control the world. We're talking about the banks that control the world here, okay? We're talking about the Goldman Sachs of the world, JP Morgan, all right? Now, these guys, these big funds, they employ the smartest individuals. Okay, these guys are even smarter than the government. Yeah, forget the government, all right? They employ the smartest individuals to figure out what the economic trends will be in the future, okay? This things like unemployment and all that kind of stuff, all right? So if these funds believe, so let's say, for example, news comes out, and the news sounds pretty bad. But if these funds, if these insiders, these smart guys, if these funds believe that in 3 months' time, the job reports, the job figures will improve, they will decide to buy. Okay? So remember, all this happens way beforehand. Forget all that new stuff. If these funds believe that in 3 months' time the job figures will improve, doesn't matter how bad the job news is, they will buy. Okay? And the same applies in the opposite. If good news comes out, again, if a politician or the president comes out and says, oh, we're going to create more jobs, and the funds start selling, it's because the smart money has sat down and figured out it doesn't matter if we got 100,000 more jobs. The market is not going to buy. It's not going to work out in the future. Okay? So this is what's important for you guys to appreciate. This is why news is completely irrelevant and useless. All right? So have a look at this. This is the charts. So why have I got this here? When you look at a chart, okay, especially on the right-hand side of the chart, okay, remember, we only trade from the right-hand side of the chart. When we look at a chart, we are not seeing what's already happened, all right? Because the news is already out. What we are seeing is expectations of market participants. What we're seeing is expectations of these big funds 3 to 6 months down the line. Okay, does that make sense? All right? So here, just give you an example. This is why the reason I'm showing this, by the way, guys, is because this is why most of us professional traders, we trade off the charts. We don't really care about all that economic news out there. Okay, the news, as I said, is irrelevant. This is why we trade off the charts. Because just give you an example. About a few weeks ago, or about a month or so ago, I remember I said that I'm going to short the euro. I got an email the same day from a journalist, and this journalist said, Alessio, are you crazy? You saying you're shorting the euro? Didn't you hear just Mario Draghi, of the ECB president, just said he's going to pour money into the system? And this is the thing. So this is why. It doesn't matter what Mario Draghi or whoever the news, whatever says. If the price action, if the charts tell me that the smart money, the insiders are not buying, then I'm going to go with insiders. I don't really care what the news is saying to me. I'm going to go with what the insiders are thinking. All right? Yeah, Ross, we'll talk about that in a second. So paying attention to the news is worthless. The reaction to the news is what matters, okay? So write that down somewhere. It's not the news itself, it's how the market reacts to the news. The price action is what really matters. So what I want to know is not what the... By the way, let me just make this clear. The news media know nothing. All right? The news media do not know nothing. It's what the insiders, we want to know what these guys are thinking. All right? So I want to know what these smart money guys are thinking. All right? Are the funds buying or are they selling short on the news? So that's what I want to know. So information for the classes, information, the insiders. What is this? What is information for the classes? So this is what I wanted you guys to understand is that whenever the smart money, and again, I'm talking about the funds, the insiders, whenever they make decisions, they leave footprints. And again, guys, being a good trader is a bit like being a good detective. You know those detective shows? I don't know if you watched them, like CSI. What do? If there's some kind of a murderer or a serial killer on the loose, they look for, trails. They look for not footprints necessarily, but they look for trails of evidence to show where this guy is or who is he. All right. So you follow the footprints, you follow the trail. The same thing applies in the markets. Because you see, when these insiders, do you think when these insiders take action, make decisions, do you think they will leave footprints, yes or no? Yes, of course they do. So, in the old days, in the 1980s, or maybe in the 1970s, when technology wasn't so far advanced, these guys could do things and they could hide their trails. Not anymore. Nowadays, things have become so transparent that when these insiders, when these big money guys, they make decisions, they leave their footprints. So as good traders, we got to look for clues, as Sanjeev says. Yeah, look for clues, look for the patterns, look for the footprints, follow where they're going. What we want to know, again, guys, what do we want to know? We want to know what the smart money is thinking. What are these guys thinking? What are these guys doing? So charts are visual representations of the markets, what we're talking about here. So that's why I believe in the Dow theory. So I'm a strong believer in what's called the Dow theory. All right. What is a Dow theory? Well, the Dow theory just says the markets reveal all available information. So everything there is to know is reflected in the markets through price. Okay. The charts represent the sum of all the fears and the hopes, expectations of the investors. Everything about earnings expectations, So interest rate expectations, product launches, everything is priced into the markets. Yes, even presidential election hopes and all that kind of stuff. So there really is two types of analysis. So we've got what's called fundamental analysis, and we've got something called technical analysis. Now, as you probably have known me for some time, I lean mostly towards chart or technical analysis. But there's nothing wrong with fundamental analysis either. I just personally prefer to lean towards technical analysis of the charts. And you'll become more familiar with this as we go through the webinar today as well. All right. So Rihan, about natural disasters, I don't think so. No, I mean, there's a limit to how much the markets can price in. Obviously, there are events like natural disasters that are shock events. They are unexpected events. I will guarantee, yes, that is true. I'm not discounting there are shock events as well. Now, here's why the stock market is a leading indicator of the economy, all right, and why so much of what we hear about economic news and from economists does not matter. By the way, if you are an economist and you're listening to this, no offense intended, but just realize that I may offend you in this webinar. But anyway, the stock market is a leading indicator of the economy, which means what? Have a look at this. This chart shows you the economic cycle, which is in green, and it shows you the stock market cycle. All right. Now you tell me. Have a look at this. You tell me which one is leading the other. All right. So which one is the leader here? And you will see. Have a look over here that the economic side. Let's have just put it over here for you guys. Notice that the stock market bottoms out before the economy bottoms out. All right, does that make sense? So the stock market starts to rise higher before the economy starts to rise higher. This makes the stock market one of the most important leading indicators of the economy. The same thing here. The stock market tops out. All right. That's why many of us were predicting a market economic crash back before 2008. Because what we're seeing, what was happening on the stock market. So the market tops out before the economy tops out. The economy is lagging here. All right? That's really important to understand here. So let's go back here. All right, so have a look at this, by the way, guys. Have a look at this. This could be any stock. It could be any market. All right? Let me ask you this. Which direction is this market going? Which direction is this stock going? Up or down? It's down, right? Exactly. It's a no-brainer, right? Now, why am I even asking this question? Here's why. Because imagine this. Imagine at this point somebody told you that this stock, whatever it is, or this company, has a good PE ratio. Am I going to buy it? No. Why am I not going to buy it? Because where is this stock going? It's going down. I know if I'm going to buy the stock, I'm going to probably lose money on it. Now, let's say a few months later, okay, a few months later, Bloomberg comes out and says, hey, we got some good recommendations, a buy recommendation on this stock. You should go buy. You know, this is the thing. Bloomberg comes out with a recommendation. Have a look at this. Am I going to buy this? No. Why not? Why am I not going to buy this? Because it's going down. Exactly. If I'm going to buy this stock, all I'm going to do is going to pour money into the toilet here. All right. Same thing. A few months down the line, good earnings report comes out. Do I care there's a good earnings report? No. Why? Because the market is trending down. If I'm going to keep buying the stock, I'm going to lose money. That's why there's a phrase out there that says the markets have predicted. Let me just write this down for you guys. Discard. So I'm going to write this down for you guys. The markets have predicted. By the way, I will give you a copy of this as well. Have predicted 5 out of 3. I can't even type. Recessions. Okay, that sounds a bit strange. What that really means is that is the reason why we pay attention to price. Price action, and the charts is key. All right, let's go back. So now, having said that, folks, I mean, it's not to say that I don't pay attention to some fundamentals here, all right? So I do look at just certain fundamentals, and I'm going to show you what I look at here. So let me show you what I mean here. There's a question here from one of you Uz. Yeah, you're absolutely right, Uz. I'm sorry for pronouncing your name wrong there, by the way. He says that it's all very well looking in hindsight. Yeah, you're right. It's in hindsight, this was going down. You're absolutely right, by the way. I'm going to show you in this webinar tools that you're going to need to show you how to put the odds in your favor. So yes, it does look like the market was going down in hindsight, but I'm going to show you how you could have actually known this market was going to continue heading lower. The probability of this was to head lower in the long term. So I'll show you this in a moment. Now, so what are the strongest and weakest markets? I always like to keep an eye on these things, like what are the strongest industries, what are the weakest industries, all right? So here's what you want to do. You want to go on a website like, this is actually from Market Watch, okay? So if you go to leadingtrader.com/industry tool, all right? So what I mean by this is, but when you go to this will give you this little page right here, all right? And this is actually from a website called Market Watch. And the reason I look at this is if I'm ever going to, for example, if I was considering buying a stock into any industry, or if I was going to trade a particular stock or market or sector or industry, I would always pick it in the strongest. Okay, I would go and buy in the strongest sectors. All right, not in the weakest sectors, obviously, but in the strongest sectors. The question is, how do we find out which industries or which sectors have the strongest momentum in their favor? This is what you do. You go on this website, and you go and click 2 months. You put the drop-down arrow to 2 months, all right, and it will tell you which sectors have, which sectors have been doing well in the last 2 months. Now, doesn't mean that if they've been doing well in the last 2 months, they will continue doing well in the next few months. No, but the odds are higher. The odds are higher. If I put money in one of these funds, in one of these particular industries, I'll probably make more money than if I was to pick one of the horrible ones, like the ones over here. Take a look at this, for example. On the right-hand side, you will see it says the 10 worst performing industries, like the airlines index, travel and tourism. So guess what? If I put my money into any of these industries, I'm very likely to lose money. All right, because the momentum on these ones. By the way, I will talk to you more about momentum in this webinar as well. So I'm more likely to make money in the ones that actually have momentum in their favor, like these ones here. By the way, I also recommend, if you're more of a long-term investor, if you're more of a long-term minded person, to change the settings to 6 months. When you do that, by the way, you will notice that the top performing industry, by the way, just let me show you, the top performing industry in the last 2 months was precious metals and gold and silver, things like that. In the last 6 months, the top performing sector has been what? Home construction. It's down 36% in the last 6 months. And mortgage finance, 20% in the last 6 months. And by the way, this may not come as a surprise to you. I don't know if you heard in the news recently, but Warren Buffett just recently announced about a few weeks ago that is betting big on the housing market. All right, so there is I mean, when people like Warren Buffett actually come out and say things like this, I do pay attention. So let me talk about key concepts here. So in this next bit of the webinar, what I really want to do is just go through some very important concepts that traders use, that we use in the markets. They may be a little bit basic, by the way, but I do ask you to bear with me because I know some of you who are beginners may not know the meaning of some of these terms. Okay, that's why most of you are here anyway. So let me ask you all a question. Let's do a questionnaire with all you guys. The market consists of blank. Who can tell me what does that mean? Market consists of what? Good. Well done. Absolutely right. Buyers and sellers. Most of you got that right. One of you wrote thieves. You're probably right there, John. Okay. But price is determined by. By the way, actually, he's not wrong because John said the market consists of thieves. He's not wrong. Let me just write this down for you guys. Here's an important thing you guys should know because this is actually one of the most important phrases I stick by. Okay, write this down somewhere. Amateurs hope, professionals. What's the next bit? Who can tell me? Professionals what? So amateurs hope, professionals steal. All right. So amateurs are hooked on hopium. Okay, please, please, whatever you do, guys, don't be one of those guys. Amateurs are hooked on a drug, are hooked on hopium. I'll hope the market will go in my favor. Please don't be like them. And I'm sure you won't be. But I'm pretty sure you know people who are, right? By the way, I said this because I myself was one of those people, all right? So I'm not saying this to make myself look superior. I myself used to be one of those people many years ago. When I started 10 years ago, I was one of those guys who hoped, oh, the market will go in my favor, okay? Professionals do not use hopium, okay? They use rules, risk management, and all that. We'll come to all that stuff in a second. All right, so that's, I think, very important point to mention there. Okay, so market consists of buyers and sellers. Price is determined by supply and demand, all right? And supply and demand is determined by what? Who can tell me? Supply and demand is determined by, yeah, the aggressiveness, well done, yeah. The aggressiveness of buyers, the bulls, and the sellers, the bears. So bullish and bearish. Again, I want to go through this bit quite quickly because, you know, I know that some of you guys know about this already. So bullish just means, again, guys, I know this, for most of you, this is pretty basic, but please bear with me because I have to cover this for our beginners in the audience. Bullish means buyers are more aggressive than sellers. Buyers are in control. So the market has a greater probability of rising. Bearish just means sellers are more aggressive than buyers. Sellers are in control. So market has a greater probability of falling. Long and short. Again, you hear this from traders, from me and many people all the time. Going long. Going long means you're buying, okay? You're buying into a market. You're betting on the market going higher. Selling short or going short just means the opposite. You're betting on the market going lower and profiting from a falling market, from falling prices. Then we've got things like bar charts. Okay, we've got bar charts, and this is what a bar chart would look like. Now, I know some of you are not familiar with these kind of charts, but a bar chart just simply looks like this. Okay, so you see bars like open on the left. The tick on the left hand is open, tick on the right is close, and that's the high and the low ranges, okay? By the way, bar charts are also called HLOC bars. HLOC because it's high, low, open, and close. And then we've got things like candlestick charts. Candlestick charts look like this. And the best way to understand candlestick charts is just to understand that when it's green, it's a bullish bar. It means the market went up on that day. And when it's red, it means it's a bearish period or bearish day, for example. Or the market went down on that bar. Okay. So if you look at Apple here, this is Apple on a daily chart. All the green bars you see here, or the green candles, means the market went up on those days. The red ones means the market went down on those days. Okay. Now look at time frames. And again, this confuses a lot of beginners and a lot of folks who are new to trading. Time frames really are the different chart time frames that you look at. So let me explain this. We've got intraday time frames. Intraday means anything less than a day. So you got 5-minute, 15-minute, 60-minute, 4-hour time frames. And then we've got daily, weekly, monthly time frames. Here's an example. This is a 5-minute chart. A 5-minute chart just means that each bar that you see here, each bar forms after every 5-minute block of time. All right? Whereas a daily chart means every bar you see here forms after every single trading day. Okay? I hope that kind of makes sense. So that's similarly, if you had a 60-minute chart, if that was a 60-minute chart, that means every single bar forms after every 60 minutes, and so on and so on. Okay. So let's talk about trading styles. And again, many beginners are confused by these terms, so I have to cover these for you guys. We've got different levels of trading, different styles of trading. Let's begin with position trading. Position trading is when you hold a trade for usually more than a month. This sometimes is called investing as well. This is typically when you would be holding a stock or a market, you know, whatever, an asset, usually for more than a month, typically 2 to 6 months. If you're doing this, then you'll be trading on daily, weekly, and monthly charts. Okay, and then we've got something called swing trading. Swing trading is I do quite a lot of this myself, which is you hold a trade for more than one day. If you hold a trade for more than one day, so if you enter a trade on Monday, you close it, let's say Tuesday, Wednesday, then that's what we call a swing trade, typically 3 to 14 days. In this case, you'll be trading on 60-minute, daily, and weekly charts. Okay? Day trading. Day trading is, of course, I do a lot of day trading myself. This is when you enter a trade and you exit a trade on the same day. So you never hold a position overnight. Okay, so that's basically what we call a day trade. Trading on 5-minute charts, 15-minute charts, and 60-minute charts. Okay, then we got. By the way, I do recommend, guys, if you are a beginner, please do not do the last one right there called scalping. You don't want to go even near that. This is very short term, entering and exiting a trade for a few minutes or a few ticks. Not recommended for beginners. You'll be trading on very low time frames like 1-minute tick charts. I actually will tell you this. When I first started trading many years ago, one of my mentors, he was a scalper. And I'll never forget this because he told me the Armani suit that he was wearing, he was wearing this awesome, amazing, gray, kind of shiny Armani suit. And he told me he made the money for that Armani suit within just a couple of minutes of trading. All right, so he was trading big size, by the way. But please don't be tempted into that kind of whole get-rich-quick kind of mentality. It's not really worth it. That's why I pointed out for you the best kind of if you want to learn quicker, I recommend swing trading and then day trading for you guys. All right. Now, people, I'm going to cover this bit quickly because people do ask me this question all the time, and I may forget there later. Charts and trading platform, very simple, guys. For charts, you probably know that I quite like TradeStation. I also like the ETX charts. So ETX charts, go to this link, leadingtrader.com/ETX. And I recommend use this link here that you see on this screen because you get bonuses with this. When you sign up with this link, you'll get a bonus practice account, a demo account, and you'll also get a £250 or €300 safety net. So that kind of gives you kind of a safety measure for 10 days. All right, it's very helpful. If you're in the U.S. and Canada, then of course you cannot use this particular trading platform or chart. For you guys in the U.S. and Canada, I recommend TradeStation. I've used that myself for many years as well. This is the link you want to go to, leadingtrader.com/charting. All right, so that's all there for you. Have a contact there you can have a look at. On ETX, and again on leadingtrader.com/ETX, this is what you do. On this little bar on the charts, there's a little drop-down arrow, and you click this, or you click that, and this shows to you. Okay, this shows to you the different time frames. So if you want a 5-minute chart, you just click 5 minutes. If you want a 4-hour chart, you click 4 hours. And if you want daily, weekly, you click on this. All right? And if you want to change the charts, this chart is a candlestick chart, by the way. If you want to change the chart from a candlestick to an HLOC or a bar chart, then you just click that and you change it to HLOC. Okay? Does that kind of make sense? I hope that kind of is very, that is very basic, I know, but that kind of is important for me to cover it for many of you guys. Linus, I think Australia, you guys can also use ETX because I know of, one of our subscribers is using ETX. All right. All right. And again, that's the link up there for you guys for you to use. Okay. So let me talk to you guys about one of the most important concepts. Garish in Hong Kong. Yeah, I think in Hong Kong as well. Again, I can't be sure, but you can try it out. Rick, as far as I know, MT4 is fine if you want to use that as well. Yeah. Support resistance. So, yeah, some of you are asking me about the monthly fees. There is no monthly fee as far as I'm aware. There's these charts. Let me just show. These charts on ETX on this one are completely free. All right, they're real time. They are free. They're reliable. I like to use them. All right, I like to use them both for charts and their trading platform. Okay, I also like TradeStation as well. Okay, let's continue. Guys, the support resistance part of this training webinar is really important. If you can understand this bit of the webinar, pretty much everything else will fall into place. All right, guys, so do pay attention to this part, and I'm going to try and cover this bit with as much detail as I can. But if you can understand this bit of the webinar, trust me, everything else will kind of fall into place. So what is support resistance? It is kind of almost like a ceiling and the floor. Okay, some of you are saying I'm going too fast. I am going. How many of you, do you think I'm going too fast, or is this okay? Let me know, guys. Am I going too fast, or is this, what do you think? Is it okay? All right. Okay, it's okay? Good. All right. I understand some of you are thinking, okay, I'm maybe going too fast. I will try and balance that out as much as I can, guys. Okay. Thank you very much, guys. I appreciate it. Thank you. So ceiling resistance, sitting on the floor of the markets, essentially, the way you think about it is the markets have their own kind of ceiling and floor, except the ceiling and the floor is not very solid. It's kind of fluid, okay? It's a very kind of fluid ceiling and the floor, you want to call it that. So I don't actually really think of it as a ceiling and floor. I think of it as an area where price levels, where price levels stop going up or down. That's the way you can think about support resistance. This is where buyers, the bulls, and the sellers, the bears, meet at these levels to do battle, okay, kind of a metaphorical battle, and only one side will win. Okay, so when we think of support resistance, some books, by the way, and some websites I've seen mistakenly say, this is the kind of a misleading thing a lot of books will say, which is they say that at support and resistance, markets will bounce. No, they will not necessarily bounce at those levels, and we'll see why. It's an area where buyers and sellers come to meet, and only one side will win that kind of battle. Okay, and I'll show you what I mean. So let me just kind of show you here what I'm talking about here. So I'm going to grab a pen, all right, and kind of really explain to you very simply what all this means here. Okay, so let me just grab a pen. Imagine the market does this, all right. So let's say the market kind of goes up here, going higher, 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 and then starts to fall, okay, and then starts to rise, okay. Now, here's the thing. The market has a memory of where it's been, okay. So when the market is rising here, and as it comes close to this area, what happens? The market tends to pause at this area. It tends to pause. Now, why? Because the market has a memory, all right? So the market has a memory of where it has been. Why does the market have a memory? Because markets are made of people. The markets are made of buyers and sellers who are people. And people have a memory as well. So we know where it's been. So this area, this previous high, this area where the market has been, will act as resistance. And often it will hold the market. Okay, so that's why you see the market's coming up here and then pausing. And at this point, you see the market selling off. But guess what happens? As the market comes down and comes down and comes down, it comes to this previous low here. So the market has a memory of its previous lows. And usually the market will hold this price level, this low, will hold the price. This is called support. Okay? Let's go back on our chart. So let me just go back on this. So let me just give you an example here. Quick example. Actually, let me just bring back my question box here so you guys can see this too. All right, so let's have a look at this example here. Take a look at the stock or this market. It could be anything, by the way. In this case, buyers or the bulls on the left-hand side of the chart here believe the price is low. They buy, they increase demand, they push the price up, and price rises. Okay? And then what happens is, at some point, buyers and sellers come to agree. Okay? As the price rises, bulls become less aggressive. Bears become more aggressive. What happens? Bears take control and they push the price down. That level at the top right there, that becomes known as resistance. Okay? It is an area where the bulls and the bears fought battle and the sellers here gained control. Oops. Okay? And the market comes down here, of course, as the price falls, the bears lose strength here, the bulls gain control. And hence what happens is the markets start to rise. And again, the same thing continues. You know, as the market comes up here, the market has a memory of where it's been. That area is a resistance area. The market holds the price. The market holds the price at this level here, and the market starts selling off. And at this level, it holds support, and so on and so on. Until at some point, buyers become aggressive enough, and they think, you know what, at this price level, which is 132 on this market, at this price level, this market is undervalued. So we think this market is undervalued, and at this point, if the buyers are aggressive enough, they'll push through, and that's a breakout from resistance. Okay. Now, if that all went too fast for you, don't worry, guys, because it all makes sense as we go through this webinar. Okay, so bear with me. So support and resistance, we're looking at highest highs and lowest. So what are the typical support and resistance levels? These are the ones we look at. Highest highs, lowest lows, any major top or bottom, trend lines, and moving averages. Now, don't worry about these guys. We haven't covered this yet, but we will cover it in a second. But just remember, these are the most important ones here. So highest highs, lowest lows, major tops or bottoms, and we'll cover these two in a moment. Okay, now have a look over here. This is an example I want to show you. Imagine that this was a market you want to trade today. All right, so let's get our pen here. Let's go on a felt tip. Now imagine this. Imagine you were about to place a trade on this market, okay? And you're about to trade. Remember, guys, when we're trading on the right-hand side of the chart, okay? Not over here. We're trading on the right-hand side of the chart. And remember, on this side, it's unknown. Nobody knows what's going to happen here on the right-hand side. This is the unknown. Does that make sense? So, however, what do we know? We don't know what's going to happen in the future, but what do we know? We know this. The market at this point, okay, this was the highest point it reached. This is an area of resistance. What about support? Where are the support levels? Well, again, look at over here. Lowest lows, okay, any major peaks or bottoms, these are low support resistance levels, so these are support. Okay, so if the market comes up here, and especially, you know what, let me get rid of all this. This would actually work great if I hadn't drawn on this. Let me just get rid of all this. Okay, let's start again. So if the market would start to rise from here, okay, and starts rising, what's going to happen? As soon as it reaches this high point here, if this level, at this level, if the sellers gain control, if the sellers are aggressive enough, this level will hold resistance, all right? And then the market usually will then start to fall. So this level is a very important level here, which you're going to keep an eye on. An important resistance area. Okay, excuse my handwriting, by the way, guys. Okay, so it's previous highs. And as the market, imagine this though, what if the market didn't rise higher? So let's imagine the market, instead of going higher, started going lower. Well, guess what? At this point, you got support. This usually will hold the price. If it went below this level here, what would be your next support? What if it broke through this support level here? What if it continued falling? What would be your next level of support? Well, this would be it. The all-time lows at this level. Okay? So these are the areas we want to make sure we pay attention to. Okay, let's go back to the chart, the next slide. So have a look at this, guys. You tell me, okay, so have a look at this chart and imagine in your mind's eye, where are the support levels? Where are the resistance levels? Can you see them with your mind's eye on this chart? Okay? This is Apple, by the way. This is when Apple was trading at way back at about a $90 level. All right? So can you think of where are the support levels? Where, okay, tell me, okay, where's the resistance? Yeah, some of you are writing resistance is at $100. You're absolutely right. Yeah, that is a resistance level. Good point. At these previous highs. So remember, if you're trading the market, if you're placing a trade here, these are very important levels to watch out for. And previous lows are these levels here. Okay, support levels at about this region here. Okay, very important levels to watch out for. And as we can see, at this point, the Apple just broke through that resistance because the participants believe that, you know what, Apple is undervalued at this price level. It's worth a lot more than that. And that's when a breakout occurs, when price moves through either support or resistance, when buyers or sellers become more aggressive based on market events. Okay, let me talk about now trending versus oscillating markets. Was that in 2004? Actually, this was 2009, Reza. Okay. Trending versus oscillating markets. This is actually quite an important area to really cover. And let me just take a glass of water before I cover this for you. Really, guys, all you have to understand about this is that markets just go through two important phases, all right? Two phases, which is the trending market and an oscillating market. And there are only two types of trading, okay? Only two types of trading. Let me just write this down for you. There are only two types of trading, okay? So trading, actually, you know what? Let me just put one here. Trading trends or trading reversion to the mean, which is basically what happens in an oscillating market. Oscillating markets. Okay, let's go back. So what is the meaning of a trend and what is the meaning of an oscillating market? You know what? So let me just get back in my question box here so you can see your questions. Okay. So a trending market just means the market is deliberately moving in one direction. So if you look over here, the market here was moving deliberately in the upward direction. I'm going to flip L to pen. So when a market is doing this, that's a market trending higher, deliberately moving in the upward direction. Here, the market is moving deliberately in a downward direction. Okay? Whereas in the oscillating market, there is no bias. The market has no bias whatsoever in any direction. All it does is this. All right? That's what it usually does. Often you see the market sort of oscillating but at an angle, like sort of like that. That kind of happens as well. All right, so I hope that kind of was makes some sense, but let me just show you some examples here. Who can tell me, have a look at this. All right, who can tell me this? Is this a market is oscillating, would you say, or is it oscillating, or is it trending? Let me know, guys. Type in your question box. Oscillating or trending right now? Good, good, good. I think every one of you got this right. Absolutely right. Well done. It's an oscillating market. There's no directional bias. All it was going sideways. All right, have a look at this one now. Would you say this is trending or is it oscillating? What do you think? Trending or oscillating? Yeah, exactly. How do we know? Well, the basic way, the most obvious way to know is because it had a directional bias. It was trending deliberately in the upper direction. Now, of course, there are some good ways you can find out how to find out if the market is trending higher. We'll show you that in a second. By the way, and a good thing to do when you see a trending market is to start connecting the bottoms here. That's called a trend line. A trend line is a line you draw on a chart to essentially show you where the market trends are. For a market trending higher, you connect the bottoms. Okay, so let me just write this down for you guys. When a market is trending higher, the market is trending higher, connect the bottoms to draw a trend line. And vice versa. And vice versa for downtrends. So connect the tops. This is actually something a lot of people get wrong, by the way. I'll show you this. You connect the tops when the market is in a downtrend. So let's go back. All right, by the way, all of you got this right, by the way. So have a look at this. This is a market trending down. What you want to do in this situation is connect the tops. Not connect the lows, but connect the tops. Again, many people get this wrong. I've seen people connecting the lows when a market is trending lower. No, you want to connect the tops. The same thing applies when the market is trending higher. When a market is trending higher, you connect the bottoms. You draw a line and connect the bottoms. And by the way, what you want to see in a trending upward market, what you want to see is a series of higher lows. Whereas in a market trending down, you want a series of lower highs. Okay, and the clue is bottoms up for trending higher, tops down for a market trending lower. Okay. So, all right, have a look at this. Now, can you see in your mind's eye where this stock, this is actually Research in Motion, by the way, RIM, the company that makes BlackBerries, all right? Now, you can see at what point the market was trending higher and what point the market was trending lower. Now, what do? Again, we draw the trend lines. We connect the bottoms for trending higher markets, okay? So let me show you. By connecting the bottoms, we see this trend line, all right? And when that market broke that trend line, as you see here, the trend, as you can see, reversed. Here, we connect the tops. Okay, so lower highs. Lower highs denotes trending lower. Okay, once a trend is in motion, it will usually continue in that direction. By the way, yes, this is an important thing to mention here as well. When you draw a trend line by connecting the bottoms, often, usually about 60% of the time, or 70% of the time, when these trend lines break, like you see here, that is an indication of trend reversal. It doesn't mean the trend will definitely reverse, but it does mean there's an indication that it might, or it may actually reverse at that point. Something to watch out for. So also one thing to appreciate, guys, is that the trend line is also support and resistance. Right? One thing you'll hear a lot of traders say, and you probably heard me say it as well in the videos I've made before, is, for example, I say that, oh, okay, if the market is coming down here, okay, if RIM comes down to this level here, so RIM was here, comes down, I said it tests this level. It's testing this trend line. Why do we say this? Because often when we see a trend line, the market comes and forms support. Now, this trend line will hold support on the markets. Okay? And we want to see if the market will hold the support or not. In this case, it did not hold support. It managed to break through it. The same thing applies here. In this case, the market acted as the trend line acted as resistance. And the same here again. The stock came up here and it acted as resistance to the market. All right. And that will become hopefully more clear as we go through this webinar. So trading an oscillating market, we use reversion to the mean strategies. Trading a trending market, when the market moves in one direction deliberately, we use trend-based strategies. All right, guys? So remember, in an oscillating market, you cannot use strategies which work in a trading market. All right, this is really important. Whereas in a trending market, you cannot use strategies which work on a reversion to the mean market. All right, so let me explain what I mean by that. Okay, have a look at this. Now you can see this is such an obvious case of Yahoo. This is Yahoo, by the way, the stock, and this is such a very good example of a market just was going sideways, no directional bias, just oscillating, bouncing up and down, going sideways here. All right. Now, obviously, in this sort of situations, you cannot use strategies which work in a trending market, and I'll show you why in a second. But if you, this is very important, if you use strategies which work in a trending market, you will get hosed in this kind of situation here. So in something like this, what you want to do. Oh, and by the way, that's another piece of BS. A lot of books and websites tell you. I've heard some people say, or some traders say, that you cannot make much money in a oscillating market, or it's very difficult to make money in an oscillating market. That is not true at all. It's complete BS. I'll show you why. Here's what you do. Okay, write this down on a piece of paper. You can go on your chart and go on this menu, drop-down menu. Again, this is on the ETX charts. Okay, and go to Studies and go to this little indicator. What you want is an indicator called Keltner channels. Okay, choose that. The settings are 13, 1.5. And you can see that's how I set it up on my chart. 13, 1.5. Okay, put that on your chart. So select this and put it on your chart. Let me show you something really cool here. That's what happens. That's the same stock, by the way. It's the same thing I just showed, just Yahoo, except all we've done is we've superimposed on our charts this Keltner channels. Keltner channels are just indicators based on volatility. Okay, so it's a volatility indicator that... and by the way, this is actually a very important thing I want to mention to you guys. Let me write this down. There are only 3 types of indicators. Okay? And you don't need all of them. Okay? Please don't be one of these people who are indicator junkies. I've met them. I have met people who are indicator junkies. They'll switch from one thing to another. But there are only 3 types of indicators. There are oscillating indicators for oscillating markets. These are called oscillators for oscillating markets. All right? And then we got trend-based indicators. And we've got volatility indicators. All right? By the way, just to give you some example of these, oscillating indicators would be something like EG. RSI would be one. Then we got something like stochastics. All right, things like that. Again, we've got things like MACD as well. What else we got? Momentum indicators. A lot of these are oscillating indicators as well. The Keltner channels you can use also for oscillating markets too. Trend-based indicators, these are things like moving averages, MACD, that's basically moving average convergence, divergence, and a whole bunch of other stuff as well. But these are the main ones for trend-based indicators. Okay. Then there's volatility indicators. Again, things like ADX, and I'll show you what ADX is in a second. Bollinger Bands, and again, Keltner channels too. These are also volatility indicators. All right, and what else? Oh, squeeze. Yeah, one of my favorite ones, squeeze indicator as well. And I'll show you that squeeze as well later in the webinar as well. That really is the main sum of it here. Okay. Does that helping you, by the way? Does that kind of help you guys knowing that? Yeah. All right. Oh yes, an ATR. Somebody mentioned average true range. Yes, well done. I will add that to my list here. So actually, well done, whoever. Jack here, absolutely right. ATR, which I'll show you what that means as well. Average. That's average true range. Okay. So whenever you see these indicators here on a chart or a list of charts, okay, just remember there's only 3 types of indicators out there. So put these Keltner channels on your chart. Why? Because essentially what you can do with this on something like this is, and people, you know, there are people who say that, you know, you can't make money, you cannot make money in an oscillating market. That's complete rubbish. Here's what you can do. On something like this, what you can do is, whenever the market, let me just get this for you guys. So when the market hits the bottom of the band, the bottom band here, by the way, there's an upper band. Just remember, there's an upper band, there's a middle band, and there's a lower band. This middle band, this white line here, is called the mean. That's called the mean. Okay, it's also a 13-period moving average. If you don't know what if you don't know what a moving average is, don't worry, guys. I'll show that to you right now in a second. All right, but just remember, reversion to the mean means this: if you buy in an oscillating market, if you can buy at the lows, you can buy at the lower band, and then sell it when it comes to the mean. Or what you can do is sell half at the mean and then sell the remainder at the upper band. Okay. Now what you can do at the upper band is, at the upper band you can sell short. You can short the market. In other words, you're betting the market will fall. And when it comes to the middle band, you can exit half your position. And then hold the rest when it comes to the lower band. Same thing here. When it comes to the lower band, what do? You buy. Comes to the mean, you sell. Or you can sell half. And then when it comes to the upper band, get rid of the rest. Okay? When it comes to the lower band, what do? You buy. When it comes to the lower band, what do? You sell. Sell half, whatever. You can hold the rest till the other. Now, when it comes to the upper band, great. What you can do here, short. So sell short. Okay, is this helping you guys, by the way? Sell short. Comes to the middle band, what do? Exit. Half. Hold the rest till the lower band. Comes to the lower band, what do? You buy. All right, does that make sense? Do I have to go to the You buy, you sell. Okay, over here, again, you short. You short here. It comes to the middle band, you exit half. Or you exit completely if you want. Okay, buy here, sell there. Does that make sense? Is that kind of cool? Did you guys get this? All right, and this is a great way of making income. I do this a lot. I do this a lot with options, by the way. You can do this with shares too. Please don't do it on day trading. Please don't do this day trading, all right? I don't recommend it. But you can do it on swing trading or things like that. All right? Is that helping you guys? Okay, I think a lot of you are saying that it is helping you. Good. All right, so let's have a look at moving averages. By the way, guys, I realize it is now almost 10 past 3. Do you guys need a 5-minute break? Do you guys want a break, or do you want me to continue? Keep going. Just let me know. Want a break or 5 minutes? What do you think? Okay, let me just see what you guys are saying here. 5-minute break or not? What do you think? Okay. All right. All right. I see. Some of you. Okay, I think it's a 50-50 thing going on here. All right. I tell you what I'm going to do. I think it is a good idea to have a stretch and have a quick, like a glass of water. Maybe you want to go to the bathroom or whatever. Let's take a quick. I'm going to make it 5 minutes, something like 5 minutes, maybe less than that. All right. So let me just do this for you guys. All right. So let's be back. Okay, let's be back. Oh, God. So be back in 5 minutes. Okay, 5-minute break. I have it as 10 past 3. So let's be back at 3. Can we say we can back at 3:14 or 3:15? How about that? Well, I'll start, 3:15 p.m. GMT. Okay, is that good? Okay, we'll take a quick break, and we'll back in 5 minutes. We will start sharp at 5 minutes past the hour, or in 5 minutes right now from now. All right, guys, we're back. Okay, so I think I have it now. It's 3:15. Yeah. Okay, great. So let's get started. So what do you guys think? Would you guys manage to get a good quick break, or was that useful? All right. Yeah. Okay, great. Fantastic. Okay, so let's continue. All right. I remember last time I did this kind of 2-hour webinar last year, it was, I actually thought, you know what, just a couple of minutes just to refresh, get a glass of water, or just have a stretch. Does usually help. I don't know about you guys, but all right. So moving averages, let's talk about this now. And again, really what a moving average is something that averages out the price. All right. And so this is let's say, for example, this is a market. This could be any market, by the way, share, or it could be a market. And what a moving average simply does, it takes the average, the share price, all right, over a period, could be a few days, could be a few hours, whatever, and then it plots that average on the chart, depending on what time frame you're using. Okay, so that red line is a short-term moving average. Joyce, yes, it is. Okay, so this is a short-term moving average, and this blue line is a long-term moving average. Okay, so we got short-term and we got long-term. All right. Now, why do we plot these moving averages on our chart? The reason is for a number of reasons. I mean, I'll show you this right now. One typical reason is what's called a moving average crossover. Okay, when these short-term moving averages crossover, and I'll show you what I mean by short-term in a second. The ones I use, I'll show you this. When these crossover, that tends to you that the market bias is changing. So, for example, when the short-term goes above the long-term, it shows the bias is towards the buy side. And by the way, where do you think the market goes towards the sell side bias? Yeah, when they cross over in the downward direction, like there. So a crossover in this direction, when the short one goes above the long-term one, that's a buy, and this one is an indication of a sell. So let me give you an example here. Now, this is an example of Dollar Tree, and one of you, by the way, I remember one of you sent me a question earlier saying, hey, Alessio, everything looks great in hindsight, but how could I have known a market was going in this particular direction before it's already happened? Because you can look at this chart of Dollar Tree, or whatever, this could be any market, for example, and you could say, oh man, this was a fantastic trade. If only I had known to buy it, at when was it here? So if only I had known to buy it when it was back at $22, and if only I had known to sell it at $40, everything looks great in hindsight. But how would I have known it in advance? So let's plot two moving averages on our chart. Okay, that's a short term and a long term. Okay, and that looks something like this. Now, all I've done here is plot two moving averages, and I'll show you what these ones are in a moment, but don't worry about that. We've got one red, we've got one blue, and I want you to focus on where they cross over. Okay, you see where they cross over in this chart? By the way, this is what it looks like if I just remove the price. See that? If you remove the price, that's what it looks like. All right? With the price on, it looks like that. So guys, let's do an exercise together. I'm going to move my hand. Sorry, I'm going to move my cursor from the left to the right, and I want you to tell me where you buy, where you would sell. You can whisper it to yourself. Actually, I recommend say it out loud. That's the best way to learn. Say it out loud when you buy or when you sell, depending on the crossover. Let's go now. Okay, good. If you said buy, that's a good one. Right. And sell. Right. Now we come over here. And what's that? It's a buy. Okay, and then we continue. Notice, we hold on to the trade. We hold on. There's no reason to exit at this point. No reason to exit until finally, bam, sell. And then we get a crossover here, buy. And then, bam, there we go, buy as well. And there's a sell right there as well. Right. Now, I know some of you are probably thinking, well, I'm cherry-picking this particular trade here because not every market will look so clean and nice like this. It's absolutely true. I will show you some examples of markets where the moving average crossovers just look horrendous. So I will go through and show that to you. But it's just a very simple example of what it would look like in an ideal situation. Okay, so that actually would have given you here three very nice and profitable trades on Dollar Tree or a particular stock. So what are moving averages? It's a line that smooths out fluctuation in the stock price. So for example, an 8-day moving average is the average for the price of for the most recent trading days. Now, there are two types of moving averages, simple and exponential. By the way, please guys, don't get caught up into this this whole what kind of moving average do I use? Because I get emails all the time from folks saying, hey Alessio, do I use a simple or do I use exponential? Honestly, it doesn't matter. I've seen charts work with both kinds of moving averages. Please don't get involved into any of that. Good, proper trading is not about what kind of moving averages or what setting of moving averages do you use. That's not good trading at all. It helps, but it's not about what proper trading is all about. So please don't become obsessed into that kind of mentality. But just for you guys to let you know what the difference is, a simple moving average is giving weight to each day's price, whereas exponential moving averages give extra weight to recent prices. In case you're wondering, if you're not sure as to which one to pick, just choose exponential. So if you're ever unsure, choose exponential. That's what I would do. All right. So here's Starbucks. You can see Starbucks gave two moving average crossovers here. So here it was a sell when it crossed over in negative direction, and over here was a buy. Okay. I just put that as an example here for you guys. Here's a question for you. Could you have made money when the shares were going down? Yes or no? Absolutely, yes. And as you probably know, that's the way I like to make money when shares are going down. You could do it by buying put options, selling short, or spread betting. If you're in the UK, you can just call spread betting or spread trading or things like that. So use a combination of two moving averages for crossovers. Now you can use whatever you like, but I personally like to use 8 and 21. So why 8 and 21? Why not like 10 and 20? No reason why. You could use 10 and 20 if you like. 8 and 21 are something called Fibonacci numbers. Okay, so I like to use, so I'm just going to put this down for you guys. I like to use Fibonacci numbers for most of my moving averages and time frames. All right. Now the time frames is optional. You don't have to do that with Fibonacci, but that's just to let you know that. Fibonacci numbers, I'll explain to you later, just are less arbitrary. Fibonacci numbers occur in nature, and that makes they're less arbitrary than if you just pick any number. Okay. And they actually work pretty nicely in my opinion. Okay. Oh, by the way, in case you're wondering what are Fibonacci numbers, just to let you know, Fibonacci numbers are things, okay, so we're talking about 3, 5, actually, you know what, you don't need those ones. Let me just tell you the ones, 8, 21, let me stop 13, 21, 34, 55, what else we got? We got 89, 144, then we got 233, 377, and so on and so on. You don't have to go on continuously. Those are the ones. I just memorized them, so that's basically what I do. All right, so let's go back. So here's the thing, folks. I use 8 and 21 for the crossovers that you just saw. I also like to use 13 moving average as an entry point. But by the way, always have a 50 and a 200 moving average. Now you can use exponential, you can use simple. Honestly, it doesn't matter. The reason why you should have these two, the 50 and the 200, is because it's used by almost the biggest, the big funds out there. Hedge funds use them. The big funds use them. They do pay attention to them. Okay, so that's why you should always have them on your chart. Okay, take a look at this. This is how I have my moving averages on my chart. Okay, that's what it looks like. And in case you're wondering what they are, here they are. So in order, the 8 is that red line you see there. The 13 is the white line. The 21 is the blue line. The purple is the 50 moving average, a simple moving average right there. And the 200 is a simple moving average. And again, a 200 moving average just means it averages out the price over the last 200 periods. Or if you're looking at a daily chart, that's the last 200 days. It's averaging them out. Okay? So here's why I use a 13 period moving average. One of the reasons is I like to use it because it's banging between the 8 and 21. So it's kind of a nice compromise. The other reason is that I just find it works really well for entry points. Okay, so I use a 13-period moving average for that. So here's what it looks like on the charts. You go to studies, you go down here, you pick exponential moving average right there. And if you want the simple moving average, just scroll down, and it's right there. It's a simple moving average. Okay, simple as that. Here's an example of a 200 moving average in the charts. This is why I use a 200-period moving average on all my charts, and it's for this simple reason. Greg, I'll see if I can do that for you. So this is the S&P 500. This is the stock market. So have a look at this. You'll see several times. This is last in 2011. Notice how many times the market came over here. Oops, what happened there? Okay. All right, here we go. So notice so many times the market came to this 200-day moving average. It came here, it tested it, tried to break through it, it failed. Failure at that point. And then what happened to it? It came over here, didn't succeed over here either. Then the market came up here, tried to break this 200-period moving average. Did it succeed? No. Fell apart. Then it came again here. It tested it, and then what happened? Didn't get through. Finally, success. So it successfully broke through at that point here, and then managed to go up here. And what happened here? The market came down. This is actually in June, by the way. Look what happened. On the stock markets, it came down, and it found support. Support at the 200-period moving average. Remember those things we just talked about? Support, resistance. Oh, by the way, one thing to always remember about this is this was resistance here, so this was resistance. Let me just write that down. Resistance. All right. In fact, you know what? Let me just write this down for you guys. All right, I'll just jot this down on my notepad. So, when price is above the moving averages, okay, MA, the MA act as what? Support or resistance, guys? Let me know. If the price is above the moving averages, does the moving average act as support or resistance? Which is it? Support or resistance? Support. Well done. And the opposite applies as well. When price is below the moving averages, speaking like a robot, yes, the MA act as resistance. Okay? And that's an important thing to always remember. So let's go now to the next chart. Okay, here's an important thing I want to write down, guys. It's a warning about moving averages, and this is what I told you before. I wish I could say every chart of moving average crossovers were that attractive. And by the way, you know what? I've seen books, I've seen websites where they give you all the nice examples, all the nice cherry-picked examples when, moving average crossover, and people think, oh my God. Let me tell you, I went to a seminar one time when this speaker was showing like an audience of 500 people these moving average crossovers, and he did not show one example when those moving averages looked like this. Now imagine you were taking moving average crossovers or something like this. All right, I mean you get hosed. You trade a market like this on moving average crossovers, your account will be slaughtered very fast. But of course, there's guys out there, unfortunately, who are not particularly honest, and they just show you good examples, the things that worked out, but they never show you examples where the things didn't work out. And here's the thing, guys: if ever you see anybody, a book or a speaker or a website showing you examples where things worked out, but never show you an example where things didn't work out, just, leave it alone. Okay, those kind of people probably don't have your best interest in mind. All right, just to let you know that. You always want to see them showing you examples where things didn't work out. All right, otherwise there's something really wrong there. So, yes, Susan, exactly. So write this down. So moving average crossovers only work when stocks are trending. They do not work when stocks are oscillating, when reverting to the mean. So we never use moving average crossovers when stocks are oscillating. So we never use moving averages when things are doing like this. Can you imagine every time you see buy, sell, buy, sell, buy, sell? I mean, you'd be ripped apart here. You get hosed here. Just endless crossovers here. So yeah. So here's the biggest problem traders have, which is most traders. I mean, this is the question I hope you're asking yourself right now. This is the question you should be asking yourself right now as I'm speaking, which is this: how do I know when the markets are transitioning from oscillating to trending? It's all very well me saying, oh, don't use moving averages in oscillating markets. Well, thanks, Alessio. But how do I know when it's transitioning from trending to oscillating and from oscillating to trending, right? Vincent, you're absolutely right. I'll come to that, yeah. So knowing this is important. This is so important, all right? And by the way, guys, what I'm going to show you right now, if you understand this bit, and if you just get this one bit here in the webinar, all right, this will put you way ahead about 90% of people out there, okay? Because so many people just do not get this. And when they don't get this, they start to lose money, okay? The reason why so many people lose money in the market is not just because of risk management and all that, but it's because they don't understand that you cannot apply strategies or systems that work in a trending market to an oscillating market. That's why there are systems, you can buy systems out there that work in a trending market, okay, the nice trends like moving averages when markets are going nicely, deliberately in one direction. But when those markets stop trending and you still continue to use those systems, what's going to happen? Yeah, your account will just get slaughtered. You will start losing. That's why then those people will start to lose money. And because those systems cannot detect when these situations, when the market's transitioning from an oscillating reversion to the mean market to an oscillating market, all right? So in other words, that's why, for example, why you see people saying, oh, they're using this system, right? They're using a system that makes money on trends, all right? And their account is going like this. They're going, woo, making money here. And then when the market switches from trending to oscillating, when that transition takes place, what happens is all the money they've made, all this nice profit they've made, bam. Okay? They just start to lose everything. And that's why so many people have difficulty trading, because they don't understand this key transition. So this is what I'm going to show you guys, and what I'm about to show you is going to really help you. So write this down. Let me just see if I can go to the next slide here. Okay, here we go. What I want you to do, guys, is this is why I use volatility indicators. Remember, guys, there are 3 types of indicators out there. What was the 3 types of indicators again? Remember? Yeah. I just showed you this up there. Okay, so there are 3 types of indicators, wasn't there? So there was oscillators, trend-based indicators, and there's volatility indicators. Let me tell you guys, if you're not using any of these indicators, you're missing out. If you're not using any of these indicators, ADX, Bollinger Bands, Candlestick Channels, or at least 1 or 2 of them, you don't have to use all of them, but at least a few of them, all right, you're really missing out. And I think it's highly important that you do start using them, all right? Vincent, yeah, you're absolutely right. ADX is the same thing as DMI, okay? So let's go back here. So I use something called the ADX, or Average Directional Index indicator. And this is a really cool indicator because it tells you when the markets are going into choppy mode, and when essentially what it tells you is when volatility is decreasing and volatility is increasing. All right, so when volatility is expanding, okay, you most likely will see a trend. Now here's a rule you want to remember with ADX. With ADX, by the way, if you want to know how to get this indicator, it's really simple. And by the way, let me just tell you this. ETX didn't have this indicator about a few months ago. All right. So what I went and done is, what I did is I went to the office at ETX and I met the corporate manager, and a very nice guy, by the way, very decent, nice guy. And I said, listen, my traders, the people who I'm teaching, need this indicator. All right. So I want you guys to put this indicator in there. And they're very nice. This is how so efficient they are. This is how very efficient and nice they are. Within a week, I think it was about 2 or 3 weeks, they added this indicator to their list. Okay, so that's now there. Didn't used to be there, but it's now there. So click this ADX there, and the setting is 14. All right. So put that on your chart. Just remember, whenever the ADX is below, okay, you did that, Alvin? Okay, fantastic. So whenever the ADX is below the 20, that's when it like this. Just beware, the market is about to get into choppy mode. So whenever the ADX is below 20, just remember that the market is more likely to be oscillating and not trending. In this kind of situation, you don't want to be doing any kind of trend-based strategies. All right, you want to be doing reversion to the mean strategies. Okay. Similarly, if the market is, if the ADX is above 20, then that's fine. Then you can go into trend-based strategies like moving average crossovers, or buying pullbacks at moving averages, or selling into pullbacks at moving averages. Okay. So remember, above 20 ADX shows trend strength. So the trend of the market is getting stronger. Below 20 means weakening trend. Just means be careful if you're using trend-based strategies. All right, so have a look at this. This is Apple. This is Apple from about last year, from September of last year till now. Look at this. From September till January, where was the ADX? The ADX was below 20. And this was telling you, be careful. You don't want to be applying trend-based methods right now. All right, see that? All the Apple was doing, what was it doing? Up and down, sideways. But as soon as ADX went above 20, look what happened. Boom. The market just started trending, getting stronger and stronger. So in this situation, something like this, then yeah, you can buy pullbacks. And by pullbacks mean you can say, okay, you know what? So you missed the crossover? Fine, doesn't matter. I can buy a pullback with a 13-period moving average. So buy pullbacks, like the 13 EMA, for example. All right, so that's what kind of thing I'm looking at here. And the same thing. By the way, notice over here there was also a low ADX here, but I like to, if you're using trend, so here trend, here reversion to the mean. Okay, does that make sense to everybody here? Okay, fantastic. A pullback, by the way, you know, some of you asked me what's a pullback, just means waiting for the market to retrace back to the moving average. So you never want to, this is the thing, you never want to buy at the above the moving. You want to buy close to value. Let me just show you what I mean here. Let's just remove all this stuff. All right, so just remember this, folks. Moving averages act like magnets. Price never stays too far away from its moving averages. You see this here? You don't want to go and buy at the highs. Wait for it to come back close to the moving averages here. Buy at value. So buy at value. That's what we mean buying a pullback to the moving averages. The same goes with shorting as well, by the way. All right, so let's go to the next slide. All right. This is IBM. Again, what is this telling you? Low ADX, below 20, be careful. Be careful of low volatility. Low volatility, what does it mean? You have more chance of an oscillating market. Choppy market, stay out of that. Once it goes above the 20, trending market. So you can actually start to do trend-based strategies. Over here, low ADX, again, it says be careful. Market went sideways. Goes above 20, right over here above 20, that's great. Market starts trending again, okay? So use an ADX, average directional index, setting of 14. If ADX is below 20, be very choppy market. Use reversion to the mean strategies. Reversing for increasing trend strength, ADX above 20. And also I like to use squeeze breakouts, by the way. Squeeze, the squeeze indicator that I use is really important, by the way, as well, because it shows to you when a market is transitioning. So I know many of you have seen this video already. For those of you who haven't, a squeeze essentially is formed when these Bollinger Bands, okay, these blue lines, go inside Keltner channels. And in case you're wondering, where do I get the Bollinger Bands? Where do I get all this stuff? Okay, let me just show you. There they are. Oops. Again, you go to Studies, pull down the indicator list. Bollinger Bands right there. Settings of 20 and 2. Keltner channels, settings of 21.5. MACD, or you can use momentum. Doesn't matter, whatever you want to use, momentum or MACD. Settings of 821.9 for the histogram. All right, and that's what you need on your chart. Okay. Now here's how you use it. When the Bollinger Bands go inside the Keltner channels like that, what does that mean? that means the market is shifting from high volatility to low volatility. And it also means you should pay attention, because when the market, when this squeeze fires, when these Bollinger Bands, what does it mean when a squeeze fires? It means when these Bollinger Bands exit the Keltner channels. When that happens, it means you're transitioning from a low volatility environment to a high volatility environment. And by the way, I did not actually come up with this squeeze indicator myself. Two very bright traders in America came up with this, and now I actually use this all the time in my trading methods. Okay, so really is a very useful indicator to have. I wish I could take credit for it myself, but I can't. Okay, and over here I use a MACD. MACD, just I use it as a bias. If MACD is above 0, if it's positive, then you buy. Okay, if it's below 0, then you sell. You sell short. Okay, just remember that's MACD is used as a directional bias. I will talk to you more about MACD and momentum in a second, by the way. So just bear with me in a second. All right. So have a look at another example. Got tongue-tied there for a second. Okay, have a look at this. Take a look at this, guys. I wonder how many of you would have traded silver back in 2009. Actually, I beg your pardon, it's 2010. Yeah, actually, I remember this is 2010. I wrote about it on my blog, and I've told everybody about this. I mean, I bought silver when this. Let me just show you when this happened on silver. You see this nice squeeze breakout? Okay. Now, how many of you would have liked to have known about this when it occurred back in 2010? Notice this. Notice the Bollinger Bands go inside the Keltner channels right here in July 2010. Okay. Then, notice this. Low volatility. How do we know it's low volatility? For one thing, because Bollinger Bands are inside the Keltner channels. We've got a squeeze. Okay. Then, is the ADX above or below 0? Sorry, is the ADX above or below 20? It's below 20, right? So if it's below 20, that shows to you a period of low volatility. Okay. But what you want to watch out for is when the squeeze fires off and when this ADX suddenly then explodes above 20. That shows to you a transition from low to high volatility. And look what happened on silver. Look at this. Silver went from just about $20 and it continued to go, wow, look at this, to $45 to $50. All right. And that's a phenomenal move here on silver. Okay. So let's go here on. So let's go to the next chart. Some questions are coming through. Okay, Taruj says we don't have you don't have Keltner channels in your chart. Look, if you don't have the Keltner channels or whatever ADX, then just choose a better provider of charts. Okay, that's why I recommended to you guys the charts here on. That's why I recommended to you guys this. So. Just go on this, and it's free, so you can use. This is a good, reliable chart. Switch your charts if they're no good. Get a better chart provider. As simple as that. Okay. Important reversal patterns. Okay, so here I want to talk to you about some reversal patterns. So this is important because it will give you some early indications of when markets are about to reverse direction. So here we've got a double bottom, head and shoulders, and the cup. For me, the most important indicators I watch out for really is a double bottom and a head and shoulders. Okay. Now, have a look at this. This is on a Dow Jones last year. Can anybody here tell me what pattern you could see on the Dow Jones index last year? What pattern was this? Who can tell me? What was this? Out of these three, what was this one? I think most of you got it right. Yes, exactly. It's a double bottom. Because why? It made one bottom here in August and made another bottom here. And that was a very important reversal pattern. In case you're wondering why it was a reversal pattern, I'll explain it to you in a second. I'll show you an example of why in a second. Who can tell me this? This is on Google. What pattern can you see? What reversal pattern can you see on Google here? Anybody tell me? A double bottom, head and shoulders, or a cup? What was this? What was this one? Yes, I think most of you got it right. Yes, it's a head and shoulders or a reverse head and shoulders, whatever. This is called the head. These are the two shoulders. All right. Now, some people ask me, Alessio, why is it? I mean, here's another one for you guys. This is on S&Ps. This is actually just a few months ago on the S&Ps. What was this one, by the way? What was this one? Was this a cup, head and shoulders, bottom, double bottom? Yeah, exactly. Head and shoulders again, right there for you. So people say, why is this an important reversal signal? Why does it work? Why is it an important reversal? It's really simple. And when I explain it to you guys, it just completely makes sense. Do you remember what was a sign? What is a signature of a market trending lower? Do you remember that? What is a signature of a market that is trending lower? Do you remember that? Lower lows. Well done. On lower highs, lower lows. Yes, lower lows, lower highs. What about a market trending higher? Higher lows and higher highs, right? Now, let's go back to this one over here. Lower lows, higher lows. Sorry, lower lows and lower highs. But guess what? When the market comes here and makes another bottom, but the bottom is not lower. Remember, the bottom is not lower than this bottom, all right? That says to you that this market is weakening in strength. In other words, the trend is weakening to the downside. And actually, it's beginning to reverse its direction, okay? Because remember, for the trend to continue, you want to see lower lows, right? But it doesn't make a lower low. It fails to make a lower low. That becomes a double bottom, all right? So similarly, what if the market did this? It's going lower, 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 making lower lows, and then instead of making a lower low, what does it do? It makes a higher. Actually, you know what? That wasn't a very good example here, so let me just do it one more time here for you guys. What if it did this? So market here comes down, and then you expect it to make another low, but it makes a higher low. Instead of making a lower low, it makes a higher low. So what do you get? You get a head and shoulder pattern. That shows to you, remember, higher lows are signatures of what? Of an upward trending market. Higher lows are signatures of an upward trending market. Okay, does that make sense? So that's what happened here. You expected this low to come and breach this low here, but it didn't. It made the higher low. Therefore, the market was saying to you the market is changing its direction. A good way to actually spot these head and shoulder patterns is think of it like this. Think of this as two eyes and a nose, like a smiley face. Right? When you see a smiley face, it means a positively biased market. The market could be actually starting to trend higher here. Okay, does that make sense? Okay. All right. So, hope that kind of makes sense. Anyway, so let's go to the next slide here. Yeah, that's one of my favorite patterns is also called a double top. A double top is a bearish reversal pattern. So all these ones were bullish. Bullish, of course, as we know, means market reversing higher, going upwards. Bearish means these are indications of market going lower. Okay. A double top like this. Okay, have a look at this. This is on gold. Did anybody spot this pattern on gold last year? This is a very important pattern here. Look at this. Gold went to $1,900 an ounce. It made the high. So all this time, what was gold doing? It was making new highs, new highs, new highs. All right. And at this point, almost everybody was going crazy on gold. Whoa, gold is going to 90. Gold is going to go to 2,000. I'm going to go buy gold. What happened? Gold came up here. It tried to attempt going higher than this level here. Again, remember, guys, what is this level called? Previous highs. What are they called? What are these previous highs called? What did we call them earlier? Resistance. Right. They are resistance. And it held, this resistance level held. At this point, sellers, the bears, got in control. They did not allow bulls to push through this level here. And what did they do? Sellers got in control, and they pushed gold prices lower. So at this point, you'd not be looking to buy gold, but shorting gold. All right? So that's a double top example there on gold. Let's go to the next one here. That's a double top. All right, so I mentioned some patterns. I want to quickly mention a volume. I don't want to spend too much time about what volume is because I don't really use it that much, but I'm just going to mention to you guys so at least you'll know I mentioned it to you so you learn it, okay? Volume essentially just means the fuel that drives market moves. It measures the distribution of shares between buyers and sellers. A good way to think about it is volume indicates the buyers are more volume means there are more buyers are committed to the position. There's more conviction behind the move. All right, that's what really it means. So really, just want to let you guys know that's what volume is here. You can see it on this chart. Just want to let you guys know I don't actually use volume a lot in my trading. I look at it, I keep an eye on it every now and then to see how much money is coming through, but I don't use it actively as part of my trade. I know some books and some gurus out there say, oh, you need to see volume. No, not really. Believe me, I've seen markets go up on low volume, on very light volume. So whoever's saying that the market cannot go up on low volume is not true. It can. All right? And a market, by the way, can also sell off on low volume too. So I don't really use volume a lot in my chart, in my trading, but you know, if you have it, if you want to keep an eye on it, by all means, just to see how much money is coming through the markets. Okay? So momentum. One of my biggest, I would say, if I was to call myself any kind of trader, I would say I'm a momentum trader. And that's why I say to you that I don't use volume a lot. Because for me, momentum is more important than anything else. Okay? If I'm going to trade something, whether it's gold, stocks, silver, God knows what, you know, you mentioned it, bonds, whatever market, I want to see momentum in my favor. Okay? So I hope that kind of makes that will make some sense to you guys. But I'm a momentum trader. All right, and a lot of the traders you see and you meet probably fall into this category too. Some people fall into what's called value trading, value investing. For example, you might buy gold because you think, okay, you know what, it contains value. But sometimes you want to buy something or you want to trade something not because it has intrinsic value, but because you know that this market is about to do this. So is about to do something like a hyperbolic move like that. So instead of a stock that goes like, instead of a market that goes like this, like willy-nilly after many months or maybe after many days just goes like this, you want to see a market with momentum behind it. So you want to see a hyperbolic move like that. Right, so that's what I'm looking for. When I say I'm looking for momentum, I'm looking for those kind of markets. Now, you're probably wondering why. Alessio, why would you say that you're looking for momentum in the markets? Why not just go for markets that have value? Here's the reason, okay? Here's the reason I want you guys to understand. You see, there was an article in the paper. I don't know if you read this, but it was in the Financial Times newspaper about a few weeks ago. And this lady, let me just show it to you here. This lady in the article, she said this. She said, this is probably the most ridiculous article I've read in my life. She said that she bought a stock a few years ago, and all the stock was doing was this. Oscillating sideways, making her zero money whatsoever. Okay? That's all the stock was doing. I won't mention the stock to you guys, but let's just say that's what it was. I think it was some kind of game company, like one of those Blizzard or something like that. Anyway, she said that this company had made her no money whatsoever in the last few years. And her decision was this. Her decision was whether she should hold on to it. This was her question. Hold or sell. Let me ask you this, guys. If you were her, let's say you were her, what would you have done? The stock had been doing this for you for 2 or 3 years. What would you do? Hold or sell? All right. I know I'm getting some good. Okay, here I have absolutely no hesitation telling you I would have sold this years ago. I would have sold this after month 3 or 4. You know what depending on your time frame here. And here's why: you just spent 3 years of your life holding on to something that made you zero money. Are you kidding? And by the way, her conclusion was that Guess what our conclusion was? Our conclusion at the end of the article was, I'm going to hold. That's what our conclusion was. No. All right? And the reason why a lot of people do this is because of human nature. Because why do so many people find it so hard to sell something, get rid of something that's not making them any money? Because if you just sold that stock or asset, you have to admit that you just wasted 3 years of your life. That's what you have to admit to yourself. That's why it's so hard, and that's why trading is the most difficult profession in the world. Because let me just write this down. Trading. Let me just write this down for you guys. Trading is difficult because it forces you. It forces us to do the psychologically, I can't even type here. Okay, psychologically impossible. All right? That is why trading is, that for so many people, it's so difficult. Because they've just invested so much time and, and money. Listen, remember, time is money. If you've been holding a stock for this long, you just invested a lot of money in it as well, haven't you, right? 3 years of money, time. But here's what I would have done. I would have said, you know what? I don't care. This stock is just losing me money. Let's just sell it. What I'm going to do is I'm going to find an opportunity. I'm going to look for a market. Okay. What kind of market do we look for? Yeah, a market that's going from low volatility to high volatility. From low to high volatility. So I want to see a transition from this to this. So maybe I'm going to find a squeeze trade. Maybe an ADX going above 20. And then I'm going to go and find the setup, find a trade, and watch the stock just explode higher. All right? Or maybe not like that exactly, but something like this. All right? Something like that. Why would I be crazy enough to say, oh, you know what? I'm just going to hold on for me to just continue losing money for the next 3 years. It's just crazy. All right. But that's just a lesson in psychology for you guys. That's how people think. So what's momentum? Momentum really just going with the flow, going with the directional bias of the market. All right. So here's a traffic, for example. Remember, if you're in traffic like this, you're trying to drive in the opposite direction. You're just going to get stuck. It's impossible for you guys. It's not worth it. A train is coming in your direction. It's going south. What are you going to do? Are you going to go stand in front of the train? No. What's going to happen? The train is going to crush you. So I'd much rather go with the train in the same direction as opposed to saying, oh, you know what? I'm just going to let the train just run me over. No. But unfortunately, many people do this. Many people go against the momentum and then ask themselves why they're losing money. So we take the path of least resistance. The path of least resistance just means the highest probability trade. So in other words, we want to find the trade where the momentum is in our favor. So what is the path of least resistance? Really, momentum just means something like this. You throw a ball in the air, right? And the ball, at some point, loses momentum. Why? Because gravity acts on it. Gravity forces it down. It loses momentum here at this point. And then what does it do? It falls down. At this point, at the very top here, the upward momentum at this very high point here is 0. Okay? And at this point, when it hits the floor and hits the ground, the downward momentum is 0 as well. So just remember, this kind of thing is momentum I'm looking for. So how do we find momentum, and how do we trade with momentum in the markets? And here's a really cool tool I want to show you guys, which you can use, which is I use on my chart something called MACD, which is a momentum indicator. Just shows you the force of the trend. MACD just stands for Moving Average Convergence Divergence. And the setting is 20, 43, 3. Okay? Or you can use 20, 43, 9, whatever. Okay? Here's Netflix, or as I call it as a joke, Deadflix. Netflix, as you can see here, was at $300. So in 2011, Netflix was at $300. Now look what happened over here. The momentum on Netflix went below 0 right over here. You see that? Now look what happened here. I can guarantee you so many people were thinking to themselves, oh, Netflix has just come down to $200 a share. Maybe I should buy some. What happens is the Netflix continues to go lower. And they think, oh, Netflix comes to $150. I should buy some. What happens? It goes to $100. Oh, $100. I should go buy some. It's the bottom. It's the bottom of the market. And it goes lower and lower and lower, losing the money continuously. But if they had noticed this, they would have noticed the momentum on this trade, okay, the momentum on this market, was below zero. So when the momentum is below zero, there's no way I'm going to buy in this market. I'm going to actually stay out of this market. All right, I'm going to short. I'm not going to go buy into a market and momentum is below zero. But notice over here, it went above zero. The path of least resistance was actually to the buy side here. The path of least resistance was a downside here. Have a look at this. This is Goldman Sachs. Throughout this entire period, momentum was below zero. Now, if anybody who thought they're going to make money by trading these up moves, they would have been disappointed. Instead, what you could have done is just wait to, for example, as you can see, the momentum was actually went above zero here, and actually start to buy here when the momentum goes above zero. Again, all I'm showing to you here is where momentum is below zero, you stay short, and when it goes above zero, you can go long. Okay, so here's gold. You can see gold, momentum continuously above zero, good trades, just going along here. You don't want to fight the momentum here in this kind of market. So just as a summary, momentum measures the speed and force of a trend. So you imagine the ball thrown in the air, losing momentum, and comes back down. And when a slow momentum is above zero, the path of this is the buy side. So when a slow momentum is below zero, the path of this is the sell side. Okay, and you can use 20, 40, 53 as MACD here as well. Okay, and that's where it is. That's MACD on the charts. Setting up 20, 43, 3 is the one you pick there as well. All right, so really just want to finish off here, guys, with you guys is talking about golden rules of trading, which is you want to be decisive and take action. When a market is not going in your favor, you don't want to just sit there and say, oh, okay, I'll just see what happens. You want to cut those losses short as soon as you can. Okay, does that make sense? So be decisive, take action. When something is not working out, just cut it loose. So you don't want to be the kind of traders that do this. They buy some shares and hold on to them, hold on, losing money. You want to be doing this. When you buy some shares, not just shares, by the way. When you buy or trade any market, could be shares, could be gold, silver, stock market indexes, whatever. You want to always protect yourself by using a stop loss. And a stop loss is a sell order you place with your broker to protect you in case the market does that. So if the market does not go in your favor, you always want to make sure you're protected against losses. As the market goes in your favor, what you can do is then cancel the stop loss, cancel the sell order, and move it higher. So as the market goes in your favor, just move your stop, move it higher, move it higher. The idea is that you're limiting your losses, but you're maximizing your profits. That's the whole idea behind this. All right. Question people ask me is this: where do I place my stop loss? So where do I put my stop loss if I'm entering in a market, and how do I trail my stop? So let me just cover this for you very quickly as well. Put on your chart something called average true range. Okay, that's on every chart, by the way. Average true range. Average true range measures volatility in the market. And by the way, what I'm about to show you guys is something that's going to really help you. So do pay attention to this part. Because if you just get this little bit over here, this will put you ahead of many other people who just are using this the wrong way. Basically putting stop losses in the complete wrong places. Let's say that you were going to, or I was going to buy Apple. In fact, I did buy Apple only about a week or so ago. So let's say I was going to buy Apple at this point right over here, 620. Where would I put my stop? Well, I'm trading on this daily chart here. This is a daily chart. So on my chart, I'm going to put this indicator called the average true range. Average true range, remember, measures volatility. What does volatility mean? Volatility simply means the difference between the highs and the lows of the market. By the way, when you see average true range going higher, that means high volatility. When you see average true range going lower, that means low volatility. So let me ask you this, guys. Guys, let me ask you, do you think when the average true range, when the ATR, when this is higher, do you think you need to use a bigger stop loss or a tighter stop loss, like a smaller stop loss? What do you think? Bigger, wider stop loss or smaller stop loss? Bigger, right. In these situations, you need to use a bigger, wider stop loss. And you'll see why in a moment. In these situations, when it's lower, you need to use a tighter or smaller size. By the way, in case you're wondering, well, exactly how much size do you use? It's really simple. Let's just get rid of all this chart. Let's get rid of all this ink. It's very simple. All you do is if you're entering the market, let's say here, okay, so if I was buying the Apple here, look at the average true range. Average true range said 13. 13 average true range. So what you do is you take 13 multiplied by 2. That's the rule, by the way. It's a rule of thumb. Always use 2 times average true range. 13 times 2 is equal to what? Is 26. So I would use a 26-point stop. 26-point stop. All right. Now, if you may think that's too much, well, again, it doesn't really matter. It's not about how much you think it is too much higher, whether it's too much or too low. The point is, it has to be relative to the market. That's so important to understand here, guys. Let me show you an example on this one here. This will make sense maybe on the next slide. All right. I'm actually beginning to hear the rumble of a thundercloud behind me. Yeah. Okay. Have a look at this, guys. This is the Dow Jones Index back in 2008. Do you guys all remember 2008 when market was crashing? Do you remember how volatile that market was? Yeah. Let me tell you this. Let me tell you a little secret here. I spoke to a broker he's actually one of the biggest brokers in the world. He told me that their clients, now get this, their clients in the highly volatile market of 2008, this is a period where, if you remember, where all those things were happening. Lehman Brothers was collapsing, Bear Stearns was collapsing, the markets were in meltdown. Let me tell you, he was telling me that their clients on the Dow, when they were trading the Dow on a 5-minute chart, day trading basically, they were using a 20-point or 20-tick chart stop. Okay, so these guys, these clients of theirs, were using a 20-tick or 20-point stop. All right, 20-tick, by the way, just means that whatever this is. Okay, so difference between that. So let me ask you this: how crazy or insane was this? Look at the volatility in the market. What does the ATR tell you? The ATR says to you, have a look at it. What was the ATR reading right over here? Right over here. What was the ATR reading? About 100. 100 points or 100 ticks. This is back in 2008. So somebody who was using a 20-tick stop, by the way, it's not their fault. If you've been doing this too, it's not your fault. The reason is a lot of books, a lot of websites tell you, oh, go and trade the Dow, use a fixed 20-tick, or I know many traders who trade the euro, for example, are using about 20 or 10 ticks on the euro. And that's okay if the markets are in low volatility. But in highly volatile markets like this, you'll get hosed. When the volatility is like 60 or 80, you should be using twice that at least. Something like at least 100 ticks or 100 stop. So in other words, if I'm entering the market, let's say at 8,000, right? If I'm entering at 8,000 here, my stop should be, well, what's the ATR? 40. So 40 times 2. 40 times 2 is 80. My stop loss should be 80 ticks away, 80 points away from my entry. Okay? I hope that kind of makes sense. If that didn't make sense, by the way, don't worry. I understand it's kind of maybe high-level stuff here, but just remember, your stop loss should always be, so stop must be 2 times ATR away from entry. All right? That basically is the rule I want you guys to remember. So rule for stop loss, 2 times average true range. For example, if ATR is equal to 10 points, use 20 points away from your entry. 2 times ATR, 10 times 2 is 20 points. Simple as that. And yeah, you can also use a 20 period or 21 period moving average as a trailing stop loss. just keep trailing your stop on a 21 period moving average. You can see that's what I was doing here on the euro. Trail, trail, trail on 21 period moving average, and trail, trail on 21 period moving average. By trailing, what we mean is you can, once you're in the trade, you can move your stop higher on a 21 period moving average. Okay? Does that kind of make sense to you guys? All right? So what I'm going to do now, guys, I'm going to mention one more thing to you guys as well. Before I do that, I want to quickly mention this. All right, so I know many of you have been asking me about it and emailing me about this as to when we're going to do one of these events again. So what we're planning to do, myself and my two trading colleagues, Kevin and Kim, is we're doing another live trading event. Basically, this is a live practical traders workshop, which we're doing on the 15th to 16th of October here in the UK, okay, here in England. The place is Ettington in England. If you haven't been, it's near Shakespeare country. Last year we did one of these. So many people asked us as to when we're going to do another one. So we did actually eventually finally agree on a date. And the next date we've agreed, I recommend put this in your diary, guys. This is 15th and the 16th of October 2012. All right, and that's happening here in England, in the UK, in Ettington. It's basically a 5-star hotel, and it's one of the most distinguished, authentic buildings in the UK. And basically, all of us will meet there, and we'll be trading live. But you're probably wondering, what are we actually going to be doing? What is the purpose of this particular event? Let me show you. This particular event is for you if you want to learn how to turn a small account into a big account. That's what it's all about. Okay? So what does that really mean here? So the whole purpose of trading, by the way, let me just show you what I mean here. The whole purpose of trading is to do this, all right, is to turn your account, in other words, your capital account, your trading account, take it from here and make it increase to here, all right? So let's say, for example, you're starting with, let's say, 10,000 pounds or, $10,000 or whatever it is you're trading with. So if you're starting with 10K, and you want to learn how to make that into something like 20K, this is how you go about doing it. Maybe you want to learn how to do this to turn it into 50K. Okay? That's what it's all about. Now, unfortunately, so many people do not know how about doing this. So what they do is they start with 10K or 20K, and they start to make a little bit of money, and then, bam, they start to lose it all. Then they make a little bit of money, and then start to lose it again. So their kind of equity curve looks something like this until finally they just give up and it leads to failure. So what you ultimately want to achieve is something like this, where you take your account from 10K or whatever you want to start. Maybe you want to start with more than that, 20K, whatever. So it's for those of you who have a trading account. Maybe you've got some money set aside. Maybe you got some 2,000, 5,000, 10,000, whatever it is you want to start with, and you want to learn how to go about turning this and making this bigger. All right. Now, going back to this, so we'll be doing this on the 15th and 16th of October. Myself, Kevin, and Kim, and I'll be there as well, of course. And we'll also be trading live. This is the thing. It's not just about sitting there and learning about theory. Okay, it's not just about theory. Hey, just some stuff on PowerPoints. The point also is to place real live trades with us on the days. All right, this is exactly what we did back the last time we did this in March. So you'll be there with us. This is actually a picture of Kevin, Kim, and I was actually behind this over here. So we'll all be there. Bring your laptops with you by all means. We'll have a good internet connection. And what we're going to also be doing is not just showing you how to turn your account into a bigger account, okay, but also showing you how to place live trades as they come. And here's the thing. This is why it's so important. Yes, also if you're startups. Yeah, some of you asking, what if you're beginners? I'll come to that in a second. Let me just show you what I'm talking about here. Imagine this. I want to ask this question. Imagine that you were going to learn how to play golf. Okay, so you bought some books on how to play golf, or you watched some videos on how to play golf. Great. So you read the books, you watched the videos. Tomorrow, you go on the golf course, and you're standing next to Tiger Woods. All right, what's going to happen? Who has the advantage there? It's obvious, the professionals. the thing is this, guys. Many people don't realize that's exactly what happens when you're trading the markets. When you're trading the markets, it's exactly like being on a golf course next to Tiger Woods. All right? Remember what I said earlier? Amateurs hope, professionals steal. Professionals are just basically their job is to, the professional traders are just there to take money away from the amateur traders. All right? So really, when you're trading the markets, you want to be trading with the professionals. You want to be trading with the smart money out there. That's basically so what we're going to be doing on this event in October is showing you exactly how you go about it. So when you're getting into the market, live on the markets, we'll show you what to look for. So we'll show you how to trade the setups we're going to show you, and also how to scale in, scale out, manage a trade, when to trade, when not to trade as well. But most importantly, how to turn your account, whether you have a small account or a big account, and how to double that account, and how to take it from small to larger. This is the thing as well. Many people don't understand is that you need to first increase your account. You need to first build your account before you can make an income from it. All right? So the idea is if you have 10, 20K, so let's go back here. If you have 10 or 20K, let's say you got 10K. Once you made 20K, great. Now you can use 20K and start to use that to build more. Okay, so now you got 20K. Now you can use 20K to build that into 50K or 100K. All right, does that make sense? And once you've made a 50 or 100K, you can use that to make a decent income from it. For example, if you got 50 or 100K, you don't have to make 5%. You don't have to make 10% every month. You can make 3% or 5% every month. You can live quite decently on that. So the purpose is to actually increase, to increase your capital, increase your account before you can make an income from it. And that's what this event is all about. Now, the last time we did this, people said to us, okay, Alessio, what about those of us who live abroad, live overseas? So for you guys, what we've done here is this. But for those of you who want to come to the event, obviously want to meet us face-to-face, and there's a lot of bonding involved, obviously, when we're there. Then this is the date on the 5th and 6th of October. And for those of you who want to come to the online event, then this is the link. This is the event you want to come to, 29th and 30th of October. So in other words, we'll give you a link, and you can join us online. Same teaching, by the way. All right, so the same exact teaching and the same exact live trading we'll do with you as well. You will also get the complete trading DVDs with it as well. This is Kim and Kevin's trading DVDs that they've made for trading markets. We're actually going to be offering this near the time. So when it gets to October, we're going to be actually offering this at $2,997. All right, but you guys can have the early bird discount today at only $1,497, and that's the link that actually you want to go to right here. It's leadingtrader.com/go. All right, and in fact, let me just show you. This is what happens when you go on that link. Okay, when you go on that link, leadingtrader.com/go. What you see is you'll see a video of Kevin here, looking very handsome and dashing, as you can see. You see some information there about the event right there, and just come down to the page. You'll click this link to add to cart, and what happens is when you click that, so let me just show you exactly what happens. Okay, not quite sure where that came from. Okay, here we go. So what you do there is this will be the next page. You go on this drop-down menu and just tell us which one you want to come to. So for those of you who can make it to when it comes to the UK event, the Ettington event, and the hotel, that's the one you want to go to. But for those of you who are saying, okay, I'd love to come to the UK event, but I live overseas, I live too far away, I want to come to the online event, great, then come to the online 2-day event. Both are 2 days, same teaching, okay, and you click that one. All right, and that basically is it, as simple as that. Any questions, by the way, guys, feel free to always email us. That's the support that's a support email, sam@easytrade.com, and that's a telephone number which is available for you guys from Monday to Friday during business hours as well. Now, here's what I want you to do, okay? So grab a piece of paper and pen, because I want you guys to do this, all right? Once you have registered on this event, yeah, a lot of you are actually saying to me that, thank you very much, Pat, I appreciate that you appreciate the fact that we're doing this online event. Because I realized last time, so many of you, I know we got a lot of people living in America. We had a member last year. I don't know if she's here. Her name is Janice. Very lovely lady. She flew all the way from Dallas, Texas, to come and meet us in Ettington, in the UK. I don't know if you're here, by the way, Janice. She came with her husband. We had a fantastic time, by the way, there as well. And the thing is, so many people said, okay, I live in Canada, I live in the States, I live in Australia. I'd love to come to the event, but it's too far away. Great, guys. So for you guys, we've got an online event for you guys. That's on the, as I showed you, on the 29th, 30th of October. The live event, Ettington, is 15th, 16th of October. So here's what I want you to do. As soon as you registered for either of those events, okay. So whether you're coming to the live event or the online event, whichever you're coming to, what I want you to do is drop me an email. Okay, send it to alessio@leadingtrader.com. Put in your subject box, okay, trading the markets. Okay, just tell me these things: your trading story, what do you struggle with, and if you could master one thing about trading or about what you're doing right now, what would it be? The reason is, by the time I see you guys in October, I want to have a kind of background on you. So when I meet you, whether in the online event on the web or whether I meet you at the event in the Ettington, in the hotel, when I see you, I say, okay, hey, John. Oh, okay, so you're the one who emailed me about that. Fantastic. So Sam, so you told me about you're having issues with entries and exits. So I'll have more of a personal background about you. So when I meet you guys, I will be able to target what you guys want out of this. Does that make sense? So please do tell me. And one more thing, people always say to me, hey, Alessio, is this suitable for if I'm a beginner? And the answer is, let me just show you. First of all, let me just put this here for you. This is, this should be in your, just going to put this in the chat box. So that's the link, leadingtrader.com/go. And let me just tell you this, guys. Many people say to me, hey, Alessio, whoops, that's not the right one. There it is. So people say to me, what if I'm a beginner? Okay. So here's what I'm going to do. If you're a beginner, okay, and if you really think that you need some extra, training before you come to the event, all right, I want you just to email me, again, on the same email address I just showed you, that one. All right, and I'm going to do this for you guys. Actually, the email address I'm going to put here for you guys. Alessio, email me at alessio@leadingtrader.com. So if you are a complete beginner and if you need more extra backup or whatever training before you come to the event, I'm going to do a free 4-hour webinar for you guys. Okay, 4-hour webinar just to give you that extra bit of kind of backup and training. Just basically my aim is to take care of you guys. Okay. I've always believed that whoever comes to my events, whoever comes to anything I do should get 100% value. Okay, that's what. Because I know if you don't get 100% value, then I'm not going to get stories. I'm not going to get the good emails from you. I get emails from you guys all the time, I've shown it to you guys before. But I want to hear your success stories. So my aim is to do the best I can. That when you guys come to the workshop in October, that you are 100% ready. So as soon as you registered, guys, on that particular on one of those events, so again, you go to www.leadingtrader.com. That's leadingtrader.com/go. That's the link you want to go to. All right. Once you've registered on that for the online event or the UK event, whichever one, just email me on this. Okay, and let me know if you're a beginner, okay? And I'll sit down with you. I'll invite all of you to a free 4-hour webinar. We'll sit down. We'll look at the markets. I'll answer to you individually, and I'll spend as much time as you need, guys, on that 4 hours, okay? Just to give you that extra bit of backup, all right, guys? So let me just go back to that chart. So that's the link, guys. That's where is it? Yeah. So that's leadingtrader.com/go, and looking forward to meeting, obviously hearing your stories and hearing from you guys as well. All right. So I'll come back to this in a second. Before I do that, though, let me just mention one more thing because I want to cover this with you guys as well. All right. Actually, let me just take some of your questions while they're coming because I know some of you are answering questions here. Yes, William, it will be. That is correct. Yes. Cedric, have you ever used GAN trading techniques? Cedric, I personally have used them in the past, but I don't use them anymore. I don't really find them particularly, I mean, if it's working for you, great. But I don't particularly use them myself in my trading, no. I don't have particularly much use for them, all right? Okay, so Ross, with the dollar on the downside, and actually, you know what? Just 1 second, guys. Okay, so let me just put it here for you guys. All right, yes. So a question here: how do we protect against this probability? What's the best route to gain? All right, Ross, I see what you're saying about the whole dollar situation. You know what, Ross? I'll cover that for you in my next video update. So I was obviously with the dollar on the downside. Dollar down, obviously it's going to have upward pressure on the metals like gold and silver. I don't know. I mean, we don't know how long it's going to last. If dollar is going to get bearish for how long, but we'll see. You know, that's going to come clear in the next few weeks or so. All right. So what exactly are you teaching on this course from one of you? Again, the whole purpose of this course is for those of you who want to learn how to build an account. All right. So it's an account building course. So not only are you learning how to trade properly, so in other words, learn how to trade live on the markets. So no more PowerPoints. You know, none of that just theory. It's practical live trading. Okay, so we're going to show you how to live trade the markets. But it's also about how to build your account. So if you have some money set aside, if you have 2,000, 5,000, 10,000 pounds, whatever set aside, and you want to learn how to build that into 10,000, 20,000, and 50,000, 100,000 pounds, then this is for you. That's the course for you. All right. Will the online have fresh trades or repeat? No, everything on the online event will be fresh. Yeah, so it'll be brand new. We'll look at the markets live as well. Yeah. Henrik, as an experienced trader, I think you should talk about money. Yeah, you're right, Henrik. Money management. I definitely we will cover money management for you on these events. We will talk in the future. Well, Joyce, thanks. Okay, so some of you are saying you're in Florida. Okay, great. Okay, Mindogus, how much will the online trading be? Talking in the next seminar. Yes, it is £14.97. £14.97 for both. In other words, either one, whichever you want to come to, is the same price. So whether you come to the live event or you come to the online event, it's the same price. It's the same teaching. Okay, it's £14.97. I think that's something like in dollars. I can't remember how much it is in dollars. Someone work it out in dollars for me if you could. But I think you just multiplied by something like 1.55 or something like that. All right. I think something like it, right? What is it like? Just over $2,000, right? Yeah, $2,000. Thank you very much, guys. $2,300, right? Okay. Yes. Thank you, Robert. That was fantastic. Thank you very much, Robert. I appreciate it. Let's have a look. Girish, I use FXCM. Would they trade against me? I know there are some brokers that do trade against you. I can't tell you which ones do, which ones don't. I wouldn't really worry too much about that. I would say this: as long as you're following good trading principles, all right, then it doesn't really matter whether they trade against you or not. If you're trading with good, solid trading principles, risk management, it doesn't really matter because you'll be amongst the 10% who will make money, and there are those who won't. Okay. Right. Just going through your questions, guys. All right. Great webinar. Thank you. Thanks, Ethan. I appreciate it. Right. Morris, how you doing, Morris? What are you doing? Okay, guys. I'll explain to you guys later. All right. Do you use any of the three types of indicators together at the same time? Good question, Eric. Do you use any of the three types of indicators? Yes, I mean, certainly. I mean, it depends which indicators you mean. But yeah, I mean, if I'm trading the markets, I could use ADX. I could use moving averages. Yeah, I definitely have moving averages on my chart. I would use the ADX. I would use the squeeze. Definitely, I would have them all. You don't have to bombard yourself with all those indicators. No, of course not. But just have the main ones. So if you're trading, remember whatever kind of trading you're going to do, you want to make sure you have the volatility indicators in your chart. You want to make sure when the market when is the market evolving from low to high volatility. Morris, I'll give you a call in a second. Good to see you. Ben, okay. BPA, any good? BPA, I'm not sure, Ben. John, good job. Thank you very much, John. I appreciate you. John says you learned a lot. Appreciate it there. Thank you for a great webinar. Thank you, Jakir. Appreciate it. All right, let me just mention, okay, I'll come to your questions, guys, one more thing, because I've got one more thing to mention to you guys, and I know many of you have been asking me about it, which is Fibonacci retracement. So I just want to quickly mention this. So what is Fibonacci retracement? Okay, so this is essentially the best way to understand Fibonacci retracement is the markets often retrace about 50% to 61.8% of previous moves. And by the way, Fibonacci is something you find in nature all the time. All right, I put a picture of a face here because the relationship between your eyes and ears and your nose is all based on Fibonacci numbers. All right, so even flowers, the shape of flowers, and the distinct, the distance between your fingers is all based on Fibonacci. And basically, some bright guys in the past realized that you can apply Fibonacci ratios and numbers to the markets. How do you do this? Well, the way you want to do this is this. Go on a tool. You want to use a tool called Fibonacci retracement, which again, most charts they give you this. And have a look at this. This is the markets in August of last year. And what I mean when I say the markets typically retrace 50 to 61.8% of previous moves, take a look at this example. The market makes a big downward move here in August of last year. Now look what happened. Within a matter of a few weeks, the market managed to retrace 50% of that entire move. So what you want to do is you measure from the highs. Okay. By the way, the biggest problem that people have with Fibonacci is they don't know when or where to draw it from. And it's very simple, guys. The best way to do it is grab a Fibonacci tool and just measure it from the all-time highs to the all-time lows. So you measure from the all-time highs to the all-time lows. And that actually is the most reliable way of doing it. Typically, the 50% level is the most, how should I put it, commonly visited or the commonly tested level. Okay, that's why we look at this 50%. And yes, also the 61.8% also gets visited here as well. Notice, by the way, the market came to 50% level and then just sold off here. See that? Let me show you another example. This is the Dow Jones. This is also from October to the present. Notice what happened. Again, you measure from the all-time lows to the highs, and the market retraced 50% of that entire upward move, and then it began to climb higher. And by the way, notice this. If you'd done the same thing with this move, if you measure from the lows to the highs, this level here was just about 50%. I believe it was just exactly 50% of this previous move. Okay, so that was 50% Fib ratio. Okay, that's really all. So please don't get bogged down into the whole Fibonacci stuff, because you could go crazy with this and say, oh, I'm going to look into all kinds of different ratios. I really don't think that's necessary. Just keep it simple. As I've said before, a lot of this stuff, you just want to keep it simple. I found that's the best way to learn. All right, guys. Let me just go through your questions. Many thanks, Alessio. It's a great informative webinar. Alex, thank you very much, Alex. I appreciate that. Yes, you are getting a recording. Absolutely. Yes, absolutely you are. Thank you very much. This was fun and time well spent. Zoltan, I appreciate that. Thank you so much indeed. Thank you for coming. Can you show the ATR for S&P 500, please, and show the stop loss for that, please? Okay. I would have to get my charts there, Hamid. I tell you what, I will see if I can include that in my video for you on Monday. So if you get Monday's video, I'll see if I can include something about the ATR and the S&P 500 for you. Okay. Or if you want, email me on that. Email me on Alessio@leadingtrader.com, and I'll put it for you in the video. Magnus, it's a great webinar as usual. Thanks 1,000 times. Thank you so much, Magnus. I appreciate it. Thank you. Very kind of you to say. Worth getting up early. Thanks, Gloria. I really hope so. Thank you so much. Mikhail is. Hang on. Sorry, your questions are coming up here, so I'm kind of trying to answer, going through them. Thank you very much, Alessio. I appreciate it. Mikhail, I appreciate it. Is trading gambling? When I tell my friends that I'm interested in trading with a horror in the face, they say that, you know what, Mindogas, your friends have a point. And the reason why they probably think that trading is gambling is that most people do exactly that. They do treat trading the market as a gamble. But remember, just like poker, for example, a lot of people play poker. But there's a major difference between an amateur poker player who just wants to make a killing in the game and a professional poker player. A professional poker player, they analyze the market. They don't analyze the market. They analyze the risk. They know the odds before they even place their hands. So there's a major difference between gambling and trading properly and professionally. There's a major difference because trading professionally means you minimize risk, you maximize profits, and you got a precise plan of action. Whereas gamblers don't have any of those. Best 3 hours spent on Saturday morning, next to morning, next to morning spoon. All right, thank you. Do you recommend the trading? Sorry, what was this? Do you recommend the trading account or account? Yeah, I do recommend a trading account. Do I recommend an accountant? Maybe, yeah, by all means. If you start making over £50,000 and you want to make sure you got tax savings, yeah, by all means, get an accountant. Okay, so Vidir, what do you? Yeah, you know what? Here's a question: what do I get out of doing these free webinars? Very simple. I remember when I was, because people say to me, "Why do I do these webinars for free and all that?" Vidir is really simple. I remember when I first started, just like many of you, when I was a starting trader, I wanted somebody to show me what to do. I remember at the time, I just didn't have the mentors. Eventually, I saved up enough money to get myself proper mentors. But when I first started, well, like 10 years ago, I wanted someone to hold me by the hand and say to me, hey, look, this is what you want to do, and this is what you don't want to do. And I just wish at the time I had someone like that. And what I learned was there are so many people out there who don't have that. They don't have that kind of guidance. So what happens is they go and learn this book, this website, that website, and all that happens is you start wasting your time and wasting a lot of money as well, just going from this system to that system, this course to that course. So really, I just want to kind of consolidate and show you guys that this is what I do. This is what I do to make money in the markets. You don't need all that kind of rubbish. You don't need no kind of nonsense, and give you value for your time. Do I enjoy doing it? Absolutely. I hope that you probably gained from this webinar that I was enjoying myself a lot. I come from a family of teachers. My grandmother was a teacher for 30 years before she passed away, and it kind of runs my blood. Okay. Would I go short on Nokia? I don't know. I haven't looked at Nokia or Sprint. I'll have a look. Christopher, yes, you will get a copy of this recording. Yes. Options, no, Pat, you can't do that. But options, email me and I'll see if I can recommend you a good options broker. Your info is brilliant. I sent your video from real London to my two. Thank you very much, Patrick. That's very kind of you. Thank you. Great webinar. Thanks a lot. Timothy, thanks so much indeed. I appreciate it. Is there a live trading room? Yes, there will be. Oh, man, I just completely forgot this. God, I completely forgot to even mention this. Yeah. One of you just basically mentioned something that I had forgotten to include, and I'm sure Kevin is going to tell me off about this, which is this. Everything you see here, guys, everything here, this also includes, I'm just trying to think where's the best place for me to write this. Okay. This offer also includes live 6 months to the trading room. All right? Let me just write this down. This offer includes 6 months. I probably should have said this earlier as well, right? 6 months trading room. All right, the trading room itself is, I believe they charge like 125 pounds a month. But with this offer, you get 6 months of free access. Trading room. All right, that's the live trading room that Kevin and Kim have open between Monday and Friday. All right, so I hope that helps. That's all inclusive within this. All right, so I mean we're going to offer this within a few. I mean, actually, in October it's going to be $2,997, but you can still get it for the. All of this will be for the early bird discount of $14.97. All right. All right. So I hope that helps you guys over there. All right. So let me just go through the questions here. You're an excellent teacher. So was I. Thank you very much, Claire. I appreciate it. Oh, you're also from a family of teachers. Thanks, Larry. Yeah. Some of you are saying you've bought the CDs from us before. Okay. Here's what I want you to do. If you have already bought some of the products, some of these CDs before, because I know some of you are saying you have, contact Sam. So Girish, if you can contact Sam at easytrader.com, either give her a phone call or email her. Again, the email address is right there in front of you, right there, Sam at easytrader.com, and we'll see what we can do for you. Okay, I'm sure there's something we can arrange for you guys. All right. All right. So, what is the best way to calculate net gain at the brokerage taxes, mostly to ensure net gains from trade? Okay, Tanvir, some of these brokerages, like TradeStation, will calculate all this stuff for you, like net gain, net loss, all this stuff for you, like automatically. All right, some of them don't, but I would say you're gonna have to probably do that yourself. About taxes, you know, most of my trading is tax-free because you know it's involved something we do in the UK called spread betting or spread trading, but you know, so if you are looking for tax-free trading, look into something like that. Honestly, I don't. Look, I would say this: if you're making money, you don't have to worry about a whole tax stuff until you made your account go over like 20 to 50,000. Don't really worry so much about that. But you know what? If you like, then email us. What we'll do is we'll try and cover this bit for you at the live event as well. We'll show you what you can do as well. Alessio, we're using a MACD setting 821.9, and the next moment, the 821.9 setting on the MACD was short-term Ethan, sorry. The 2043 was the long-term setting, okay, the long-term momentum. So the path of least resistance momentum I showed you earlier, 2043, and 821.9 is just a short-term momentum. Like you can use it for a squeeze to see which is the short-term directional bias. Simple as that. Thanks, you do a great job, Albert. Thank you very much, Albert. Appreciate it. Right, short-term. Short the markets here for 25 years. Okay, thanks, Clark. Sorry, guys, I'm just going through your questions. Are you in every live trading room? Joel, I'm not. I will try to be there. I will definitely be there on the live events. But no, most of the time, it's Kevin and Kim. Yeah. But I will definitely be at these live events that you're seeing here, all right? Right. Does the price include accommodation? Oh, very good point. Somebody asked about Patrick. Okay, here's what I want you to do. We have arranged a discount for you guys, okay? So with the hotel. Again, remember, this is one of the finest hotels in the UK. So we have arranged for you guys a special discount. I recommend email Sam at easytrader.com or call her up, whatever, but just email her, and we have arranged a special discount for you guys, which includes accommodation and food. All right, and it's all so basically it'll be basically the whole point is this. Those of you are saying, well, I love to come to the event, but I'm too far away. Come to the online event. So you can come to the online event here on the 29th or 30th of October. But those of you are saying, okay, great, I want to come to the event. With the live event here, there's a lot of bonding. There's a lot. I'll tell you this: on the day when you arrive, the day before, you can actually arrive before. What we usually did last time, I remember we went on an excursion to the Shakespeare country. There's a lot of real nice tourist sites out there we can visit where Shakespeare was born. We'll have poker. We'll play poker together in the evening. Obviously, during the event, we'll have lunch together. There's a lot of trader talk and bonding that's involved there. Okay, so that's the benefit of being there at the live event. Just that you're there, all of us are there face to face, trading together, and obviously eating together and all that. So it's a lot of fun involved there. Okay, and of course a lot of teaching and trading. But again, if you can't come to the live event, you can come to the online event right there. All right. Yeah, Richie, if you want to ask, it's a pretty good offer. Just ask Sam. She has all the details, Richie. Okay, I recommend do that. As a beginner, how much do you recommend I should start trading? I recommend. It's not so much how much you should start trading, but how much you can afford to lose. Again, this is why it's important that you learn risk management as well. So what I would do is, if you're starting to trade, you could definitely start with 2,000 pounds or whatever, 5,000, 10,000 pounds. But what you really want to make sure as a beginner trader is just remember that you want to limit the risk at the very start. You don't want to take big, massive positions if you're a beginner trader. You should start really by taking 1% per trade. Okay, small. That's why it's so important to have the training first. Okay, so to have the actual, to actually have the, to someone to show you actually how it's done, and then you can go ahead and do it as well. All right. The reason some of you are asking why is it in Ettington? The reason is actually that Kevin Burton, one of our traders, again, that's the one of the guys who'd be teaching you at that particular event. He had his wedding at this hotel a few years ago, and he loved this particular hotel so much that it's such. And I will say this: it's such a beautiful place. If you've never been to Ettington Park Hotel, I can tell you it's one of the most beautiful places and amazing places I've actually stayed in. All right, and I didn't actually realize myself why Kevin wanted us to go there, but I did once I went there. Almost every single person who's gone there. So when you and I guys meet in October, believe me, it's just an incredible place to be in. Historically, if you're into that kind of stuff, and also from a trading point of view. Oh, and one more reason why we picked it here is because this is actually another good reason, because most hotels don't have good internet connection. They say they have Wi-Fi, but if you imagine this, if you have like 15, 20 people or 30 people in a room, and you're all connected to the internet, that's going to carry a lot of weight on the internet connection. So what we did with this hotel is we asked them to give us really strong, powerful internet connections. We actually had to beg them to make sure they do this for us. So that's why we're holding this event as well. Richie says, is the hotel haunted? It has been known. But you know what? If you believe in that kind of stuff, all I will say is it is one of the most famous places in the UK. If you love ghosts, then why not? How many hours per day is the workshop? Yeah, we'll be starting, guys, on the days. Okay, on these days, we'll be starting so it doesn't matter, guys. Whether you come to the live event or the online event, we'll start early. So we're going to start like 8 o'clock in the morning. You can come and join us 7:30. This is GMT UK time. Okay, so we're going to start early. Why? Because there's so many opportunities happening because the European markets, the European session opens in the morning. So we're going to start trading from that moment. And of course, you can also join us in the afternoon as well. I personally will be trading the S&Ps from about afternoon GMT UK time, which will be morning time. Those of you in the US. Okay, I love trading the S&Ps. Kevin and Kim will be trading the Euro, British Pound. But I'm mostly a S&P stock market trader. I love the indexes, the S&Ps and the whatever, the Dow Jones and all that. Thanks, Ethan. Will your principles be effective for day trading Forex? Yes, it will. Yes, Rick, everything we're teaching you in this event, online or live in UK, is applicable to the Forex markets. Absolutely. So for day trading and swing trading, yes, indeed. So for day trading, swing trading, absolutely, yes. But it is geared for those of you. It is also more suitable for those of you who want to learn how to make an income from day trading as well. Okay. What's the fastest way to contact you and get your reply? Email or Facebook? Mushfiqul, if you want to email me, it's cool. My email address is right there for you guys. That's alessio@leadingtrader.com / sorry, that's basically it. Alessio@leadingtrader.com. That's the fastest way. I will definitely be checking my emails tomorrow and today as well. Okay. Okay. One of you said, okay, if I'm going to spend 1,700 pounds on the course, how much will I spend on my trade? Well, you see, this is the thing. We deliberately are doing the course at a discount because we realize that many of you have account sizes that you want to start trading with. So we want to make sure give you a proper discount so that you will have money set aside for trading as well. But I will just say this, that, you know, I know many people who don't know how to, who don't have experience trading, who haven't learned properly how to trade the markets, and they start putting 2,000 pounds in their trading account or 5,000 pounds, and they blow it. They've blown their account within a few weeks or a few months. What they could have done instead is use some of that to get trained on the markets properly, properly trained, someone to teach them how to do it, and then actually double that account, double that money. That actually is a better way to think about it. Okay. But as to how much you want to put in your trading, you can start whatever you want. 500, 1,000, really doesn't matter. Didn't get the online info. Is there? Okay. The online info, Christopher, you're saying how do you register for the online info? All right. So I'm not quite sure what you meant by this. Oh, I see. Okay. Here's what you do. When you go on somebody asking how do you get it. What you do is when you go on the web page, leadingtrader.com / okay, let me show you where I was. When you go on that page, leadingtrader.com / sorry, then you go down the screen, you go to add to cart, okay, you click that, and that will take you to this particular page right here, all right, and then what you do is you just select that, you select which one you want to come to, 15th, 16th, or the webinar. That's the online event. So those of you saying, I'd love to come to the real event, but I'm too far away, I live overseas, you can come to this one. All right, guys? Okay, let me go back to, and yes, don't forget, guys, that as I mentioned before, some of you are asking, yes, I'll do for those of you coming to this event, whether you come to the online event or the UK event, I'll do a 4-hour free webinar. If you're a beginner, just let me know you're a beginner. Email me, and I'll invite you to the 4-hour webinar. That's once you're registered on this webinar. All right, I'll just take 3 more questions for you guys. Let's put this here for you guys. So, oops. Okay, so do you provide? Well, I recommend bring your computers there, Rick. Okay, if you're asking me, if you're asking me to how to set up your trading accounts, okay, some of you are asking maybe how to set up your trading account so it's ready. Here's what I recommend. At this particular free 4-hour webinar I'm doing, I'll show you how to get it started. I'll show you how to get started with so you can put money in your account. So by the time you come to the October event, it's all ready. Or when we meet, if you're coming to the UK event, meet me the evening before or in the morning, early in the morning, and I'll show you how to get set up. Or alternatively, just meet me in this particular 4-hour event, and I'll show you how to set up your trading account. Get it already set up, so by the time we're doing the real event, it's all good and ready, okay? Okay. Yes, Girish, you can do micro trading by all means, yes. Okay, here's a question. All right, thanks, appreciate it. How much in percentage terms have you? Okay. All right. If you want to email me on that one. Yeah. Okay. So some of you asking percentage returns per month. For me, I can't read your name there. It's just it's initials, I think. For me, my target and what I'm achieving is anything between 5 to 8%. That's per month. By the way, just to let you know. occasionally I have the good months where you make anything between 10 to 15%. But I'm not necessarily looking to make 15, 20% every single month. As long as I'm making, say, on my equity, as long as on my account I can make anything between 5 to 10% per month, which is what I'm achieving right now, that's fantastic. Okay, that's basically my goal and what so that's what I want. So I'm not looking to double my money every single month. Okay, make 100% every single month. All right, but the point is to have realistic goals, realistic trading goals, and that's what you want to achieve. All right. All right. So I know. Literally have questions. Okay, so what I'm going to do, therefore, guys, I'm just going to answer a few more questions, and then okay. I am actually one or two more minutes, and then we'll say goodbye.